today we're here with Frank Christiano of CrossCountry Mortgage, and I'm Larry Mastropieri, the broker owner of the Mastropieri Group based here in Boca Raton. And Frank is a close friend, but also a close colleague. And we work with Frank quite a bit on the lending side. So let's talk a little bit about lending. Frank, feel free to introduce yourself.
Sure. Well, first and foremost, thank you so much for having me. Really appreciate it. And so I am with CrossCountry Mortgage. We are a direct lender in Boca Raton. And what can I say? I mean, it's it's a crazy market, and just happy to be here, and really appreciate the opportunity to be on here with you guys.
Yeah, so let's get into it. How did we meet? I think we met through my mom, right? Initially.
Well, no. If you want to really go back, so I came to an open house you had many years ago at I want to say it was right by the Boca Regional Hospital. And my wife and I came there. We just had our second daughter, and we popped in there. And I had met you and Joy, and we liked the house a lot. And we ended up, for whatever reason, didn't make an offer on the house. I don't know why. But, I want to say it was probably many years ago. And then I had met Joy, which is your mom, of course. I met her about 4 years ago in the gym, not even knowing who it was. And I remember I see her name on a business card, and I said, "Are you Joy? Are you Larry's partner?" Yeah. I was like, "Oh, my God." I said, that's crazy. What a small world. So Joy and I went to the gym together for probably 4 years, and here we are today.
and then we linked up further down the road because cross-country was just, and still is, such a force in this market here from a lending perspective. And you guys were doing such great things at the time. This was, 4 years ago, something like that. And we got connected, and it just made sense to work together, right? Yep. So besides the fact that we had like this relationship to a degree, you guys were so dominant in the field. It just made sense to collaborate, and then we built a relationship further. Absolutely. Right? Yeah.
So first and foremost, where I think we're going to be a lot different than most lenders is we're a 7-day-a-week operation, 8 a.m. to 9 p.m. Team of 35 members. We have 2 underwriting coordinators that rotate on the weekends, and we're built for a real estate agent's business model, right? So if you have a buyer that's in the market and they're competing with 10 other offers, right? Where I think we're going to be different is, number one, we have the ability to pre-approve you in under 24 hours. Number two, we can get you a written loan commitment in less than 48 hours. Number three, we can close in 7 days. We do it all the time, right? So that's our big thing, right? If you have a buyer that's in the market today that's competing with cash buyers, maybe they're not as qualified as others, right? How do we leverage what we have to get their offer accepted and get them in a position where they can win in today's market? And I think we have the ability to really do that a lot differently than most companies.
And that's why you and I connected many years ago, because we needed that, right, in that market at that time, and it's still super effective right now. There's so many reasons why you want all those things you just mentioned. I want to take a step back though. Let's so talk to me about like your background. How long have you been in the business?
Sure. So I got in the business back in 2004. I was going to FAU at the time, and I always liked numbers. I loved financing. My goal at the time was to be an accountant.
I didn't know you were a FAU grad. FAU, yeah. Oh, cool. Same
FAU,
here.
Yeah.
Go Owls. Let's go.
Yeah. So when I was going to FAU, I remember it was my senior season. I was about 6 or 7 classes away from finishing up my degree. And I said to myself, I don't really know if I like accounting. I like numbers. I like people. I had a little bit of a sales background, but when I really sat down and looked at like a P&L and a balance sheet, I said to myself, I don't know if I want to do this for 30, 40 years of my life. It just seems very monotonous and boring, So I remember at the time, I had a friend of mine who was in the mortgage industry, and he was doing pretty well. He was doing well, making money, living on his own. At the time, I was still living at home, a college kid, just trying to figure out what he's going to do when he was done with college. And I remember saying to myself, you know what? I'm gonna give this a shot. I'm going to see if this is something I want to do. And I remember I got my first job at a company called RT Funding, which they were right on 2nd Avenue and 20th Street. And I remember I went in there. This was back in the day when you had the Sun Sentinel. and you looked at the classified section. I saw mortgage financing, call today. So I remember calling the gentleman up. His name was Dennis Farrar. Now, he turned out to be a genius, and I worked with many people in the industry for 21 years. By far, he knew guidelines like the back of his hand. It was incredible how good he was. He taught me a lot about the industry. I went in there, and there was no hiring process. He hired me on the spot. And the office was very old, very run down, and there was no one there. And I remember saying to myself, I'm just going to take this and just give it a shot, see what comes about. I went home, I talked to my father about it. He said, Frank, what's the worst that could happen? You're living at home. You don't need to make money right now. You're still going to school. Give it a shot. So I remember I took the position, and it was tough. You were dialing leads all day.
Wow. All right. So
basically
you went in
cold
sales.
Calling.
You were in sales.
Yeah. There was no coach. There was no mentor. There was no one sitting there. There was no training manual. It was a stack of leads. I don't know how old they were. They could have been from 2 weeks old, 2 years old. And there was a phone. And you dialed all day. And I remember my first 6 months, I did not close one deal. And I remember my mom at the time said, I'm going to give you $1,000 just to get yourself to and from your office, get yourself lunch. I was 22, 23 at the time maybe. So I was like, I wasn't really making any money. And I remember every day I would go in, and there would be days I would leave there completely discouraged and say, I'm never doing this ever again. This is terrible. Get up the next day, give it a shot. And I closed my first deal. I'll never forget. I closed my first deal 6 months after taking that job. And then from there, I just tried grinding it out. And, it's like any other sales position. It just takes a lot of tenacity and determination and grit. It's kind of like what you guys do. Your team is incredible, right? You guys are fantastic, and you get to a point where, as a single business owner, because we are business owners, we don't own, I don't own CrossCountry Mortgage, we're more of a branch, but you get to a point where you can only do it as a one-man operation or one-woman operation for so long before you've got to scale and bring on an assistant, a partner, whatever it may be, right? So, and that's really kind of my story, and here we are today, You
said a lot of interesting things that I want to dig into, and that I have passion for as well. So, first off, so you've been in the lending or mortgage industry since college. So
yes.
since you graduated college, yes. Right?
Yep.
So that's awesome. And then, most people who think about these careers, they don't appreciate the grind associated with getting into a business like this, right? You were dialing, like you said, for 6 months. That's unreal, right? So many people would have quit. And so to be where you are today came from that hustle and that, as you said, tenacity, right? So that's interesting. And so now today, so how'd you end up, so you were there working for this company. How'd you end up with CrossCountry? When did you start with CrossCountry? And
so it's funny. So when I was with RT Funding, I was there for about 2 years. And I got to a point where I said to myself, look, this company has really, I was grateful for even being hired, right? I had no experience in lending, right? So I got to a point where I needed to make a change. And at the time, I wasn't sure what I was going to do. So my wife, my girlfriend at the time, her sister was dating my now brother-in-law, Matt Weaver, who's the branch manager of the company, who's just a fantastic person overall, and I learned so much from him. Yes. And I remember he found out I was in the mortgage industry, and he said, "Hey, look, he at the time he was with a company out in Coral Springs, and he said, why don't you come in? We'd love to bring you on board. I'm looking for a partner, junior LO type." And he said, "Look, come in, check it out, let me know what you think." And I came in one day, and I remember saying to myself, you know what, I could see myself being here. And Matt and I linked up together. And we've been working together now for the better part of 15 years.
Wow. So you were kind of in that business before it became what it is today. Oh, yeah.
Yes. So I remember when I got in the business, this is 2004, and middle of 2004 is when I really took the plunge and was doing it full time. At the time, rates were in the 7s, 8s, and it was a refi market back then, believe it or not. Wow. And we were refining people from 11 and 12 down to 7 and 8%. They were leaving the closing table. You would have thought you were the greatest person in the world. They were like, I can't believe it. This is fantastic. 7 and 8%. Now, mind you, today we're somewhere in the high fives, low sixes, right? Trending around there somewhere. But when people hear 7 and 8%, they're like, oh my God, that's incredible. Like I've never heard a rate that high. Well, it's a normal market when you think about it. Now, 7 and 8 is a little on the high side, but when I got into business, again, we were refining 11 and 12s down to 6s and 7s and 8s, and people were ecstatic, hugging you at the closing table. So,
yeah, so it's changed. So you guys lived through the 2008 crisis, all that stuff. How did you survive that? Like, what did that look like?
So I think everything's a cycle, right? So when I got into it, the market really was in 04 and 05. It was crazy. I mean, it wasn't like it was during that whole period of time during the whole COVID pandemic, but it was a market that we were seeing houses just going quickly, right? Everybody was buying new construction. Everybody was refining. There was so much activity, right? And then middle of 07, 08, I remember things kind of came to a screeching halt. And I remember sitting at my desk at the time, and at the time we were brokers. We weren't direct lenders. So you had all your investors on a rate sheet, sure, right? Yeah. And I remember getting emails throughout the course of the day, so-and-so shutting down, so-and-so shutting down operations. And I would see these emails coming in all day. And you would have almost a panic attack because you're like, well, what do I do at this point? I have no investors to send my loans to. No one's buying. People aren't refinancing, and it really came to a screeching halt like in middle of 07, for me at least, middle of 07, beginning of 08 is where we saw a tremendous pullback in the market, and you just had to weather the storm, right? It's like anything else. You just outlast the temporary. You know, everything I tell myself is temporary, whether it be pain, whether it be the market, whatever it may be. If you outlast the temporary, you will get to a point where things will slowly snap back and turn the corner. And, you know, here we are today. We're slowly starting to see it, right? I know a lot of LOs in the industry were a little concerned with the market and rates and margin compression and so on and so forth, but we're now slowly starting to see that cycle moving in the right direction, turning the corner a little bit.
So that's interesting. It takes a ton of tenacity to live through that great recession period, I'm sure, right?
It's something where it's a whole mindset game, right? You just have to tell yourself, this is temporary, right? I don't know the definition of I know the definition of temporary, but it's arbitrary, right? You don't know, is temporary going to be 2 months, 4 months, a year, 2 years? We don't know. But you know somewhere along the line this is going to turn, right?
So how long was it like very quiet for? And what'd you guys do? I'm assuming you had a team at that time. You had people that were working with you. Did you end up having to lay people off? Like, how did that
2008, look? I was sitting in the office, and I remember we had, at the time, when I first started, probably 25 employees, give or take. And I remember, and this is going back towards the end of 07, there may have been 3 of us in there. Because people just got to a point where if you weren't making any money and you had blown through all your reserves, right, what do you do at that point, right? There's only so much you can do before you say to yourself, look, I have to make a decision. And a lot of people, unfortunately, were forced to leave the industry.
Staying power, right? Like you said, you got to be able to outlast that temporary situation. And I think that's really important. You mentioned this before too. You were living at home with your parents when you graduated, and you were able to kind of jump into a career that you were interested in, even though you maybe weren't going to make that money. So you had that staying power then because you could take risk then, right? At that time, you probably had more liabilities or more people to be concerned about. You had your wife or girlfriend at the time. I don't know if you had a kid at that time.
No, in fact, if it were up to her, we would have had one a lot sooner. Okay. But I was like, how are we going to do this? This is not a sustainable. Now, she was working at the time, which was nice, of course. And her and I lived together, and we had just gotten married. But when you go in and you're used to seeing 25 employees, and you open the door and there's 3, and it's just an empty office, and you just keep getting emails every day that this investor and that investor and this investor, everybody's shutting their operations. At that point, what do you do? You know,
yeah, you had it from all angles, right? People weren't lending, so you couldn't lend because you didn't have an investor to buy the loan, right? And then on the flip side, people weren't buying or transacting as much, so you didn't even have demand for a loan.
The problem was too at the time was the other problem too is there were so many adjustable rate mortgages that were coming due where people had to refinance them, but they were underwater. So if you bought a house with 5% down for $300, and then after 2 or 3 years, when you need to refinance it before your adjustable rate increases, that house you bought for $300 is worth $220 or $230. What do you do?
Yeah, and at the time they had no, they didn't have a set precedent on how to handle that, right?
No one had any idea what to do. I remember at the time, I remember first hearing the words short sale, and I was like, "What is a short sale?" And I remember a gentleman I knew. Who first introduced me to it, he said, "Yeah, I've got a couple of properties. I'm gonna do a short sale on them." And I said, "Well, tell me what is a short sale?" And he explained to me, "Look, it's you owe this, it's worth this. The bank will give you the approval to sell it for less, and you take the loss. They hit you with a 1099 in most cases, and that's it. You're freed of the liability. But of course, your credit takes a hit, and that's where that period of time you saw so many people that either bought investment properties with a low money down or no income verification with little reserves. They had no choice. They walked away, right? And that's really what that whole 2007 to 2009 period of time, that's a lot of what we saw. We don't see that right now.
Yeah, I've probably done, I don't know, 1-2 short sales a year, so very little. And just by happenstance, they come up and they work out, and it's usually a circumstance where I don't know, someone passed away, or just a personal situation, not so much a market created this situation. So yeah, very rare. And so at that time, you didn't know anything about short sales, and then all of a sudden, it's like most of the business, right?
It took about a solid year before a lot of the investors and a lot of the banks even had a process built out to where a real estate agent you'd have to submit a whole package of documents.
Yeah.
You'd have to supply bank statements, financials, because the lender or the investor needed to know if I'm going to allow Frank or whomever to be released from this liability, I have to know that they're truly going through a hardship and they can't refinance. So they would do a BPO, which I'm sure you know BPO, sure. Buyer price opinion. They would do a BPO on the property. And if they determined that you were upside down and you did not have the ability to refinance because you could not come up with the difference, to if your house was underwater and you couldn't pay the difference, they knew at that point they had to make a decision. It was either A, allow them to short sale, or B, do some sort of loan modification on their mortgage to where they would be able to stay in the property. And unfortunately, a lot of people lost their home. But in today's market, it's different, right? Today's market, we're not seeing any of that. Nothing.
Yeah, people generally speaking aren't underwater, even though the market has kind of pulled back a little bit on what the average sale price looks like here today. It's still significantly higher than it was a year ago or 2 years ago. Oh, yeah. So you're not really underwater in most cases.
What I'm seeing, and I was telling someone the other day, and they said, what's your opinion on the market? I said, the challenge with the market is when so many people refinanced in the last 3 or 4 years, and they locked in, whether it be 2, 3, 4%, right? They're landlocked, right? They can't go anywhere. So if you have a neighborhood where there are 100 homes, and 98 of those people are landlocked and they can't go anywhere, what happens when the one person that says, I'm either going to A, relocate, B, downsize, or I'm going to buy a bigger house, when they put their house on the market, it's going to sell quick. Yep. And they're going to get what they want for it for the most part. Right? Yep. And I see it in my neighborhood.
Yeah. A low inventory and pretty steady, decent demand, because we have good population growth here in Boca Raton and South Florida and Florida in general, is driving or keeping those prices pretty stable to some degree, or keeping the market healthy. If we had a lot of inventory like you did in 2008 and so on, when people were foreclosing and all those things were happening, it would be a different circumstance.
I don't see inventory. It's not. There's still a lack of inventory. Totally. Because where are most people? I mean, when you see what's going on, right, and that most people don't have the ability right now financially to make a move to where they're going to they live here and they want to go to a neighborhood that's, a different school district, or they want a 4th bedroom or a pool. They're trading a rate that's historically low for something in the high 5s or low 6s, which still isn't bad, let's keep in mind. So most people don't have the ability to do it.
Exactly.
So when that one person, when that one couple who, again, either they're buying a bigger house or they're relocating, whatever it may be, when they list their house, the probability is they're going to get close to full asking price for it.
Yeah, they're going to get a healthy number. Yeah, exactly. So let's talk about CrossCountry, and just, you kind of already brought it up a little bit. You mentioned who CrossCountry was, but let's talk a little bit more about that and how big your team is and how you think about building a team and how that came to be from, the 2008 crisis, coming out of that to now.
Sure. So I'm a firm believer that in order to build a team, you have to have, number one, you got to have the vision, right? So as a single real estate agent or a single loan officer, you can do very well. Don't get me wrong, right? You're going to put in a lot of effort, but in order to really scale, you've got to have the right pieces in place. And you see that all the time, right? You guys have a fantastic team, right? We have 35 members on our team. We have 7 processors. We have 2 underwriting coordinators. We have 3 transaction managers. We have an operations manager. We have a marketing director. We are, in some cases, I almost feel like we're overstaffed, but that allows us to do what we do, right? To where a buyer can come to us and say, hey, look, I found a property I'm in love with. There's 10 other offers on it. Is there any way that we can close this thing in 10 days? Well, we have the ability to do that, right? And in order to scale, you have to have that vision and say to yourself, maybe I'm going to take a little less, I'm going to bring on 2 people next month, right? So that's going to affect your bottom line, right? You're not going to make as much money, of course. However, because you've now brought on that marketing director or that partner, whomever it may be, now you can scale. You can go to another level, right? And I think what a lot of agents and loan officers do is they keep a very, they don't look, they don't look at the bigger picture, right? And I think that's the most important thing. Like you guys do a fantastic job of it on your team.
It can be scary, right? That's one of the reasons, right? Like you're investing in, like, you, as an example, 2 people that, maybe you don't necessarily need at this moment, but or you believe that in the future you're going to need them to do what you want to do to hit that vision. And so, that's a risk, and you're reinvesting in the business.
Taking a pay cut. Think about it.
Totally. That's what
you're taking a pay cut.
That's what
you're saying to yourself, I'm going to take a pay cut. I'm going to live on less money, and I'm going to bring on 1 or 2 people that ultimately I may not need right now. But if I wait to hire them and I really, really need them, it may be too late, right? There may be lost opportunity.
Totally.
And that's what, when we hired, I remember this was April 2020. We had about maybe 18, 19 people on our team, and rates plummeted at the time. And I remember we hired as many people as we could possibly hire. And we knew there was going to be a good 24 to 30 month period of time where there would be a need for these people, and we would find a need for them, right? And and Matt does a fantastic job of this, and I'm sure you do too. We always like to put people in their highest and best use, right? So if someone's not excelling as a transaction manager, right? Maybe that's not their role. Maybe they're better in sales, right? Maybe they're not as organized. Because if you're a transaction manager, you got to be organized. Sure. But a transaction manager and someone who's on the front line in sales are 2 different personalities, right? So maybe you're not good as a transaction manager. Maybe you're more sales. You like to be on the phone. You like to talk to people. So we'll move you into that role. Maybe if you're not good at sales, but you're very organized, you keep a great calendar, well, maybe we move you to transaction coordinator. The goal is to try to always put someone in a position where they're at their highest and best use. Because if not, there's just, unfortunately, they're not going to be, it's an injustice to them. Agreed. And it's lost opportunity for you, and it's just, it doesn't work.
You want people to be happy, fulfilled, etc. You want them to love what they're doing, right?
1,000%.
So
of course.
Yeah, we think about that all the time. It's like, what are your strengths? Let's kind of build the role around you. Fortunately for my business, I can be a little flexible in what those roles look like. So we'll build that role around that person, usually within reason, right? So yeah. So I think that's important. So how do you guys think about hiring? You guys scaled up quick. That's part of the reason why I think you were so dominant over the past few years, right? I mean, you guys from my perspective, you just took market share during that time because you were just executing. So how'd you hire in that moment?
So the biggest thing from what I see, right, and I don't make the final decision on hiring. That's more of Avi and Matt. Avi's the branch manager, and Matt's his partner. The biggest thing I see is you have to be willing to learn. You have to have an open mind, right? For the most part, we don't hire people who have experience. This is going to sound crazy. We don't hire people who have experience in lending. Because what ends up happening is if you tell us, look, I've been in lending for 15 years, right? We know that it's going to be very difficult to train you to do things the way that we do them, right? And I'm not saying our way is the best way or it's the right way, but there's a specific way that we like to do things in our branch, right? So we like to hire someone who's got an open mind, someone who understands that the first couple of months or the first couple of years in this industry, you're going to really work hard, you're going to grind, but it's going to pay off tremendously in the latter part of it, right, in the latter part of your career.
That's super interesting. I just had a conversation with a big commercial broker here in the area, and he had the same, on different words, but same kind of communication that you just gave me here. It's like, hey, I don't want to hire a commercial broker that's been in the game for a long time because they're going to be set in their ways. They're going to have certain expectations, and that just doesn't fit. And then additionally, he said, commercial brokerage takes a long time. The sales cycles are a long time before you make money, like you just said. And so he needs to know that they're able to hang in there for a year without making money. So it's very similar. And what I've found, I think, while doing this is I tend to agree with that. There's certain traits in an individual that you want, but for the most part, you can train them up within a few months to a year, and they're firing on all cylinders if they have the right traits. So they really have to fit in with our core values more so than anything. So that's what we're trying to tease out when we're talking to or interviewing new hires.
Now, Don't get me wrong. If somebody comes along that's got experience and that knows the industry very well, and we have a fit for them, we wouldn't say we're not going to hire them because they don't have experience. But for the most part, what we look for, at least on the sales side, operations is a little different, right? And someone that's in operations 15 years, 20 years, they're always going to be a value. You can't deny that, right? Because they've been doing it for so long that you can find a fit for them if you need them, right? And for the most part, we normally do. Our mindset is we're going to continue growing no matter what. There is no other option. So if we bring on a new operations person and we plug them in here, right, somewhere along the line, we're going to need them, right? That's the goal, right? Because, again, if we hire when we're desperate, any decision made out of desperation is never a good one, right? So, but in terms of the front line, the salespeople, right, we like to hire knowing that you're going to come in. This is going to be, a position where you may not make money right away, but if you're open-minded, you're willing to learn, and you follow our training, right, the way we train, you're going to be successful because we know what it takes. We've seen it. We've been in the industry for many years, so we can get that person to the next level. And again, the highest and best use, right? If we bring someone in and they want to do this, we'll give you a shot, right? But if we see it's not working, and we think that you're a better fit for a different position, we're very quick to move you. We don't like to get rid of people.
Fail fast, right?
Correct.
Yeah. That's a good philosophy. Yeah, exactly. That's our motto here too. And we try a lot of new things, as you know. And you know what I love? I love that. Hey, we're just committed to growing. So that basically means we're committed to reinvesting. We're committed to improving. Right. That whole philosophy. That's why we get along so well because we're on the same wavelength as far as that when it comes to business. And I think I was going to mention this earlier. I think it's in order to do this and and do this well, you have to have a passion for building your business, for the business that you're working in, right? And that, for me, that's what allows me to keep the growth mindset in place, right? Because it's just like, okay, we're doing this. This is exciting. We kind of figured this out. Now, what's the next puzzle we need to solve to get to the next step? Do we need to scale? Do we need to, how can we do better for the customer? How can we improve the experience? All that stuff.
This is going to sound, this might come across funny, but I got to a point where I find more enjoyment out of what you were just talking about more than anything, right? Don't get me wrong. I can still take an application. I can still pull credit. I can still structure a loan. I mean, when you're doing it for 20 years, you can do that in your sleep, right? But where I really find more enjoyment out of it, right, and what really gets me motivated and gets me going in the morning is building it, is scaling it, right? Bringing on a new hire, right? Training that person, getting them to a position where we've got a gentleman in the office. He got in the business about 8 months ago. And I'm constantly trying to show him different things because I see he wants to learn. He's in his office. He has a little corner office, and the door's always shut. He's on the phone every day. And I know someone like that is going to make it because he's just constantly trying to learn more, and he's motivated, right? That's what gets me excited. Again, I don't mind looking at a loan application, structuring a file, but that's what really excites me, right, is being able to scale it.
Yeah, same here. The systems, the training. I love, it's awesome. It's playing the game, right?
Yeah, of course.
We talked about that competitive nature, right? Before
of course.
this. Yeah, that's kind of why we're in this, right? It's exciting.
I mean, it can be stressful, like anything else, right? But it's a constant, you're just constantly just trying to add and tweak and just, it keeps you on your toes.
I think you know this. I used to be an engineer. I used to work for General Electric as a...
I didn't even know that, actually.
Yeah.
No.
So I used to work... So my background, I graduated from FAU as a mechanical engineer.
Okay.
And then I did a master's in business while I was working at General Electric, and I was doing technical sales, like an engineering role / selling to big power plants all throughout Florida and the Caribbean. And so that was fun. That was exciting. It was really cool because you got to solve technical problems. But after I left GE and started doing this, I was a little concerned about, is this going to be technical enough? Is this going to be interesting enough for me to really feel fulfilled and enjoy this? And quickly came to the realization is business is complicated, technical, like running your own business. You're doing a lot of different things. I mean, just putting this podcast together, for example, is, if you really get in the weeds, this is relatively complicated.
I saw it this morning.
Yeah, that's just the equipment setup.
I saw it this morning.
Right? Think about
I feel like I'm in an operating room.
Yeah. So I would not, I guess I say that to say I would not go back to what I was doing now in hindsight, despite the stress that comes with running your own business. And that's just something you have to work through, right? And you have to manage that. That's another puzzle that you have to solve.
They say success without fulfillment is the ultimate failure.
There you go. Yeah.
Right? So, somebody who's just successful financially, right, and there's no fulfillment, what are you getting out of it, right? Where I think you and I are very similar is our goal and what we vision is that we're trying to build something, and take it to another level, right? We're trying to constantly add more, bring on more, and that's really what gets me going, right? By the way, what year did you graduate at FAU? 2010
undergrad.
Oh wow, okay,
yeah.
You're much younger than me.
Yeah.
When I went to school there, I was telling someone the other day, I had classes at the College of Business building, and this was back in 2003 and 2004. The school looks completely different today than it did when I went to school there. I remember taking my daughter to, she had softball camp there for spring break. And I remember going there and saying to myself, this is incredible. I still can't get over. Now, she's only 11. She'll be 12 in a few weeks. And she's like, Dad, what are you talking about? I go, Isabella, you have no idea how different this school looks. I said, that stadium wasn't there. I said, that building wasn't there. Those dorms, none of this was there.
Most of those dorms, when I showed up, weren't there, or some of them were like being built at that time, just a couple of them.
Now imagine 2003.
Yeah, that's what I'm saying. So
there was no stadium on campus. In fact, I think our football stadium, they were talking about getting a stadium on campus. We still didn't have it. our stadium was all the way down in Lauderdale, I think at the time.
I went to the early on. That's where the stadium was when I graduated in 2010 or whatever, or 2011 is when the stadium was finished.
So if you wanted to watch a game, you went to school in Boca, but you had to drive all the way down to Lauderdale to catch a game there.
Yeah. The school has grown dramatically.
It's fantastic.
Yeah. No, it's. I'm glad. I'm excited for them. That's awesome. And then the master's degree programs and everything else that came out of that was great.
Not to mention we made the Final Four.
Yeah, that's what I was just going to say.
One shot away from being in the championship game. Up 14 points.
That's huge.
I'm a little sore.
That's huge. Yeah.
A little sour over that one.
Yeah. I wish they would have went all the way, but that still was a huge accomplishment, right? So let's go FAU. All right. So let's talk about just like a little bit more about business. Then we'll move on to like, I guess, adding some value maybe to the viewers about just like lending and examples and how it works here locally. But let's talk about, hurdles. We talked a little bit about this while you were building your business. What like lessons have you learned? What hurdles have you encountered, and how did you solve those in this growth phase? Any comments on that?
So I'm not going to lie. I have a lot of help, right? I mean, our branch manager, his name is Avi. He's a fantastic guy.
Yeah.
He's a genius. He's been there. He's probably the most level-headed individual I've ever met in my life. You could go in there and you can present him with anything it may be. And I always joke around. I say me and him are very similar because you could tell him and I, there's a bomb in the building, right? And our response, everybody would run out frantically, right? They jump out the window, and then me and him would say, okay, well, how long do you think it'll be before it goes off? Do we have time to finish our conversation? Can we have a little lunch before we leave? He's just a level-headed guy. So I had a lot of help from him. My brother-in-law, Matt Weaver, same thing. They've always been very good at looking at things from a bigger perspective. They have this mentality of they like to think bigger, right? And that's that's really what helped me, right? Was being able to go to them and say to them, guys, here's what I'm thinking. This is an idea I have, and they'll say, okay, great. Let's table it. Let's sit down. Let's carve out an hour and go through it together. Right? No reason to make a decision right now. Let's put everything down. Let's draw a line in the sand. Pros, cons, go through it together. And if it makes sense, we're on board with anything. They do support anything that I want to do, even though if they tell me, look, we're not crazy about the idea, but we'll still support it. So I've had that advantage over most because most people don't have two guys with collectively, 50 years in the business, one on the operations side, one on the, more on the sales side, on the business development side. So I've been able to really just see what they do, and I sit alongside one, meaning Avi, and then Matt is my brother-in-law, so I get to see him once or twice a week, so I can bounce ideas off him anytime I want. So there haven't been many challenges, I'm not going to lie. I think the thing is you got to keep people happy, right? If people feel like, and they've done a great job of that, they are the type where everyone knows their role within the team, and everyone gets compensated for their efforts, right? And we recognize that, right? We have a team that works, no exaggeration, 7 days a week. Now, there's rotating shifts, so we don't work everyone 7 days a week.
Yeah.
So we have an operation that's 7 days a week, 8 a.m. to 9 p.m. We're constantly having meetings 2 or 3 times a week, getting feedback. What other company are you going to go to where they ask for your feedback? Where they say, what could we do differently, right? What do you think we could have done differently here, right? Most companies are like, this is what I want you to do it, and that's it. These are your marching orders, move on.
And what I love, too, is, and you guys have built a great system, so, I mean, it runs so smoothly from my perspective, so from the outside, right? But you in-housed these people, so a lot of other lenders, and we'll get into this in more detail, but a lot of other lenders, outsource some of these things, so they don't have the direct control, or they can't be concerned or focused on, hey, are my people happy, like outside of the
most companies, I mean, for the most part, they're not as intimate as we are, right? And when I say intimate, I mean we hang out, I mean we work together, right? So we're together probably 40 or 50 hours a week within the office, but even outside that, right? We'll have a company happy hour. I mean, one time we did an escape room. We didn't get out. I was stuck in there. It would have been there. It's a nightmare, to be honest with you. I got so frustrated because you're competitive, and I'm like, why can't we get out of this room? But we just keep it very close, right? We hang out outside of the office, right? We're on a group text, me and 4 other guys from the office. We talk sports, we talk whatever it may be. Sometimes they'll throw in a political text, unfortunately. But whatever it may be, we try to keep it very intimate. And I think that's kind of what separates us. Most companies, everyone's remote. They don't have as much, whether it be camaraderie. I know it sounds cliche, but we do a lot together, and we're constantly trying to tweak the process to make it more, not only more efficient for the buyer and the agent, because that's important, but also to where our team is running very efficiently.
Yeah.
Right? We don't want a choppy process for anyone.
I think I need to do a better job of. We're so busy. John knows this here too. We're so busy that I think we need to spend a little bit more time on like getting together outside of the office. Yeah.
I mean, we don't do as much just because we do have a couple of employees that have either chose to work remotely, and some moved moved north and they work from home because we are very busy, right? So, but we had Thanksgiving lunches.
That's awesome.
We've had a company Christmas party every year. So we do try to make it at least once every couple of months where everyone gets together, and no one on that team feels like they're underappreciated.
Cool.
And that's the biggest thing.
Yeah. What do you like? What are you most excited about right now? What are you innovating on, working on? Anything specific that comes to mind?
So I'm a firm believer right now that we are one or two dips in rates. Is that the right word? Dips? Pullback in rates. We're very close to seeing another market where it just goes crazy. I read an article today on Housing Wire, and I'll send it to you, that 51% of homeowners currently are looking to make a move in the next 24 months. Now, what that means, I couldn't tell you, but I would have to imagine that the minute we see a pullback in rates to where maybe we're sub 5, which I know right now we're a little off, but there is speculation. I follow a gentleman named Barry Habib, and Barry is the owner of MBS Highway, and he's been very accurate with a lot of his predictions. Now, he's not guaranteeing it, but he seems to think that by the end of the summer, we're going to see a sharp pullback in rates. And I think if we do see that, you're going to see a lot of people at that point who are okay with trading their historically low rate for a rate somewhere under 5, right? Maybe even 5.25, whatever it may be, 5.5, and moving to a house that either has, that's in a different location, maybe a bigger house. I think right now we're one sharp dip in rates away from seeing a lot of activity in the market, specifically buyers looking to move up and trade up to a bigger house.
That's interesting. That's an interesting prediction. Yeah.
And not only that, I mean, we're ecstatic right now about what's going on with Hometown Heroes. So we actually finished 2022 as the number one lender in terms of Hometown Hero originations, purchases. And July 1st, there's going to be some major changes.
Talk to me about. We'll get into more of that later, but also what is Hometown Heroes? Explain that.
So the Hometown Hero program is for first-time homebuyers, or if you're a veteran, and it's a down payment assistance program that will allow up to $25,000. So basically, what they'll do is they will give you 5% of the amount that the buyer is financing. So, for example, simple math: if you're buying a $100,000 home, which is not even possible here, but let's say we found one, and you're financing 90%, so $90,000, they'll give you 5% of that as a down payment assistance grant. Acts as a second lien, no interest, no payments due, and then it's the balance is due if you sell or refinance. So, for example, if you buy a house for $400,000 and you get $20,000 from the state of Florida for the Hometown Hero program, if you sell the house in 15 years for $700,000, you only have to pay back the $20,000 with no interest.
Oh, wow. Okay. Now, how do you qualify for that? Who's qualified for that?
So up until, well, as of right now, there's about 120 to 125 eligible occupations, right? So, for example, firefighters, first responders, healthcare workers, teachers, really anyone in the medical, education, or first responders. However, July 1st, supposedly, we have a call this Friday with a gentleman named Chip White, who's the director of Florida Housing. Supposedly, they're removing the occupation restriction.
Oh, wow.
So what that means
wild.
is removing it completely. That's what we heard. So I want to confirm that with him on this call on Friday. But if that's the case, think of how many thousands of people would be eligible for Hometown Heroes. So if you work for a company that's in the state of Florida and you're a first-time buyer, you're eligible for up to $35,000. They're going to raise it from $25,000 to $35,000 on July 1st.
Wow. So that's something to talk to your clients
And
about.
they're increasing the income limit too. So the previous income limit in Palm Beach County was $138,000. And I believe they're going to be raising that. I don't know the exact number, but they're going to be increasing the maximum loan income limit, and they're going to be removing the occupation restriction, which is, I mean, at that point, it's going to open it up to so many buyers. It's going to be incredible.
Wow, that's a big deal. That's a
So
big deal.
imagine that with hopefully a sharp dip in rates. Think about that. How many people right now are renting, paying $3,500 a month, who don't have the money for a down payment, who work for a company in the state of Florida, who now might be eligible for $35,000? And then combine that with a sharp dip in rates where someone says, you know what, yeah, I'm at 2.25 right now, but I'm okay at 4.5 or 5 because I want a bigger house. I'll trade that.
And low inventory and good population growth and healthy demand already. It's just like the market.
We're not even factoring in
Yeah.
the people coming from out of state.
Exactly.
I'm just referring to Palm Beach
Locals.
County
Locals.
and Broward County.
So let's get into talking about just residential lending, what it is, what that means, and maybe we'll just compare it to commercial lending because, as you know, I've done a handful of commercial lending. So how do you communicate to people what the definition of residential lending is?
So it's really simple, right? So residential lending is going to be a mortgage on a property that's less than 4 units, right? If it's more than 4 units, it's commercial financing, which unfortunately we don't do. Haven't really done any commercial financing in my career. Maybe a handful of transactions here and there many years ago. I know you do more on the commercial side, right?
Some for my personal investments, but also for some clients that maybe I'm helping them buy like a 5-unit apartment building, 10-unit apartment, whatever it may be, that they need commercial lending. So sometimes I'll go that route with them and help them.
What do rates look like on something like that?
Right now, it's been varying. It changes quite a bit right now, and some banks have come in and out of the marketplace. For example, First Republic Bank was a bank that I was working with quite a bit on the commercial side, and as you know, with the SVB catastrophe,
Yep.
First Republic, because they are kind of I don't want to say associated with them, but they're kind of classified together. There was a run on all these regional and local banks, and so that's where a lot of the commercial lending is done, right? These regional and local banks. And since there was a run on those banks, for example, First Republic has changed their rates quite a bit because they don't have this stockpile of cash, which was their business model.
Of course.
We have a ton of cash, we can lend at cheap rates, and so they've since changed that. I'd say you're in the 6s.
That's still not bad.
No, it's not bad.
Not bad.
No, it's not bad. But when prices on a multifamily investment here in South Florida haven't come down much at all, because there's such low inventory and there's still healthy demand for that product because you got people from out of the state, out of the country, either 1031 exchanging into Florida or just needing to park money here in South Florida. And I think the fundamental belief from a lot of investors out of the area is that Florida's still a little cheap compared to California or New York, et cetera.
Absolutely.
So there's still good cash. Well, let's put it this way. There's still a lot of cash coming into the state of Florida and into South Florida for these types of investments. So values have kind of stayed where they're at, and rates have gone up, and insurance has gone up dramatically. So the world in that space is a little different.
The insurance world, it's funny you mention that. I've noticed quite a bit of insurance carriers pulling out of the market. I don't know if it's done on the commercial side as well, but I know on the residential side we're starting to see more and more of that. A lot of increases in premiums. Buyers calling me saying, or owners calling me saying, hey, my premium a year ago was $4,200 and now it's $6,500, right? So we're starting to see that as well. It's funny you mention that. We are noticing that a lot of these retail banks are trying to re-enter the market, right? So it's funny. So they pop in and out at convenient times, right? So right now, because they need liquidity, right? A lot of these banks, they want to have as much liquidity as possible, especially in a market like this. What they're doing is on the jumbo side, especially, which a jumbo loan is anything above 726,200. So if you're financing more than 726,200, that's considered a jumbo loan, right? So what a lot of these retail banks are doing, the Wells, Chase, Citi, BOA, is they're offering extremely low rates, right? Probably anywhere between a point to a point and a half less than what most direct lenders are offering, because what they're doing is they're having these individuals move their money from, let's say, Schwab to Wells, or from Wells to Chase. So they'll give you an incentive on your mortgage, right? Only if you bring your money over to another entity.
And so that's usually, I've seen that over the years, and that's what happens in the local regional bank world too. If you're doing a commercial loan and you build a relationship with the bank because you have more cash there, then they're more incentivized to give you lower rates. Because
now, granted, it's not for anyone moving 50,000 or 100,000. It's typically, if you're moving 7 figures or more, they'll offer you something that that may not even be available. Right?
Agreed.
But if it's $50,000 or $100,000, not that it's not a lot of money, right? I don't want people to think it's not a lot of money, but they're not able to get the same incentive that someone is going to get if they're moving 7 figures or more from one entity to another.
And I want to get into that a little bit more when we talk about the different types of lenders in the market and the different types of loans. So we'll touch on that more, I think, in a little bit, because I want to give a clear overview for the viewers of what that looks like. Sure. But that's a good little tidbit about that.
Sure.
So let's continue on the same vein of just commercial lending versus residential. So you specialize in residential, right? Which is great because I think it's good that you focus on a niche, right? And you guys are really good at residential lending, and that's what most people that I'm working with on a regular basis are. I'm doing single family home deals and condos and little duplexes and stuff like that quite a bit. So that's really what a residential loan looks like. It's a single family home that you're buying for your primary use to live in, maybe a secondary home, right? Maybe even an investment home, right? And apartments, but as long as they're 4 units or less.
Correct.
Yeah.
Correct.
Okay. And then the commercial world, really that looks like obviously industrial buildings and that type of stuff, retail buildings, 5 units or more in the multifamily space, that type of stuff. And I've personally worked with you on a 4-unit building you guys have lent to me on. So that you guys are competitive there. That worked. Yeah.
Absolutely.
Yeah, that was good. So we went with you over a ton of these other commercial banking relationships that I have and have built up over the years. So I think that's important to mention there. So
what's really cool about the 4-unit buildings, right, is that if you're buying a 4-unit property, you can purchase that as a primary home, live in 1 unit, and then we can use the future market rent or the forecasted market rent in addition to whatever the buyer's qualifying income is. So, for example, if the buyer qualifies, if the buyer's monthly income is $10,000 a month, and they're buying a 4-unit property and it's a primary home, number one, you can put less money down, potentially FHA, right, depending on if it qualifies, and then you can use the forecasted market rent for the 3 other units in addition to the buyer's income. So you could look at a 4-unit building and say, well, you know what, it's $800,000. I don't know if I can qualify for it. Well, based on just your monthly income, probably not. However, if we factor in what the forecasted market rent is for the other 3 units, well, then you may qualify for that property. So just something to keep in mind.
You and I have done this a bunch together for clients, right? Because just by default of my investment portfolio and what I talk about a lot is I get a lot of people that are like, hey, I want a house hack, or I want to buy a duplex or a quadplex. I want to live in one side and I want to rent the other stuff out. I want to run an Airbnb on the other side, whatever they're going to do, right? So we've done that a lot. And I think that is for a first-time home buyer or for somebody who's interested in kind of, I don't know, getting ahead, maybe is the word to use, and making really strong financial decisions, house hacking is the way to go, man.
Totally agree. What I would say is if you're a single person, or let's say you're a younger person that doesn't need the space, right? Unfortunately for me, it doesn't work. I have 2 kids. We have a small dog. and we need the space, right? But looking back on it, my first purchase was a condo. I purchased in Boca Bayou back in 2005. I said to myself, I live out in West Boca. When I graduated from FAU, I said, my plan is to go as far east as I can possibly afford. Unfortunately, it wasn't the beach. So I moved out to Boca Bayou, which is just
Great neighborhood.
Great neighborhood. I loved it. The location was fantastic. It checked all the boxes at the time, right? However, with that said, looking back on it, what an opportunity I missed out on by not purchasing that duplex or a triplex or even a 4-unit building, right? Because if you don't need the space, right, and you can live in one of the units and collect rental income on the other 3, well, now your mortgage is being paid for by the income from the other 3 units. You can live in there for as long as you can, right? And then when you need more space, you just simply depart, that becomes a departure residence. You move out of the 4th unit. You now put a tenant in there, so now all 4 units are being rented, right? It's paying for itself, may even be generating a little bit of cash flow there as well. And then you purchase a condo. Maybe you buy a townhome at that point. And then you do the same thing, right? You live in there as long as you can. Maybe at that point you run out of space, and at that point you buy a single family. Well, now you've got a 4-unit property where all 4 units are occupied and you're collecting rental income. And you've got either a condo or a townhome that you've now rented out, and you're collecting rental income from that property, and now you're living in a single-family home, but you now have 4 doors that you're collecting rental income on.
I'm so passionate about this. Yeah,
absolutely.
And I am an example of it. I still live in the first duplex that I purchased.
Okay.
So I live on one side, I Airbnb the other side.
Okay.
It's amazing. It's, quarter mile, half mile to the beach. It's a great
By
location.
the way, not to cut you off, I didn't even get into the Airbnb portion of it.
Sure.
I'm referring to just an annual rental, which of course with Airbnb you can there's a lot more income potential there,
Totally.
right? Even if you've got to factor in a property manager or an Airbnb host, whatever it may be, if you don't have the time to do it, there's still a lot of potential there.
Yep.
Why wouldn't someone do that, right? I made the mistake because I didn't know any better, right? I wanted a condo, I wanted low maintenance, and I wanted to be east, right? So that's what I bought. I bought essentially a box, right?
I got lucky. I didn't really understand the consequences of either decision entirely. My whole thing was my sister and I lived together when we went to college, and we were renting a place together with some other roommates, and I was just like, and she had a whole bunch of dogs. And I was just like, oh man, I don't want to live with these dogs anymore, but how do I keep my sister close? And I'm like, oh, I'll buy a duplex. She can live on one side, I'll live on the other side. I don't have to live with these hairy, smelly dogs, right? So that's why I ended up in the duplex. And then she moved out over time, and then I leased it up, and I'm like, oh, this is really interesting. So that's how I ended up there. I only wish I had bought a 4-unit as an example. Yeah.
Yeah, I mean, there's so much opportunity, and the biggest thing people have to keep in mind is they'll look at a property and say, well, I'm a first-time buyer, maybe I'm doing pretty well, right? They'll look at it and they'll say, I can't afford that, right? But they don't know what it really takes to buy that. Most people think there's this big misconception, or that you have to put 20 or 30% down to buy a 4-unit property or a duplex. You don't. If you're buying a primary home, you can get in there with as little as 3.5% down if it's FHA, 3% conventional.
So
right?
You and I did one, I think this is the most recent one maybe that we did together, Lighthouse Point duplex, 1 on each side, so 1 bedroom, 1 bath on each side. The kid that we helped, great guy, he could have probably afford, I think, like $450, $500 if it was a single family home, right? And he bought this duplex for almost $600,000, I think, if I remember. We were just using rough numbers, right? You and I did this together. And we've done this so many times that, and you probably don't even remember everybody that we've worked with that we've done this, but yeah. So
Definitely not.
Yeah. So there's so many nuanced details when executing on this. Like, for example, vacant units, fully occupied units. What are you going to do if it's a primary? How do you get that one tenant out? How do we make that work for the loan? All these little things. Or, hey, the rent is $1,000, but the market rent is $2,000. So you and I think, have become professionals at helping people. House hack. He put 3.5% down, if I remember correctly, and he got a great rate at that time. It was awesome, and he's super happy with that. He Airbnbs the other side. Actually interviewed him on a podcast recently.
Oh, really?
Yeah,
Okay, cool.
just to talk about he's about a year deep into it now, and he's just very happy with the execution that we were able to.
Yeah, I go back to it. The opportunity that people have that they don't realize, to me, it's incredible because I'll share a story with you. We had a buyer last week, and she says to me, I really like this one house. Can you run the numbers on it? I said, sure. She said, okay. They're asking $450, and I can only afford whatever the payment was. And it was like $2,500. She was buying in Winter Haven. So we run the numbers. I send her a breakdown. She says, look, I can afford it, but I can only afford it at this number, and I don't think they're going to take that. And we were on a conference call. It was me and her agent. And I said to the both of them, why not just make the offer? What's the worst that can happen? What's the worst they can say? No.
Yeah.
You don't know them. You're not friends with them. You don't want to be friends with them. What's the difference? Just make the offer. She was like, you know what? You're right. We'll send it in. They offer $395. Property was on the market for $449. Comes back and says, if we go to $405, it's yours. So she sends me a text on Saturday. I wake up to it. She sent it late Friday night, and I woke up to it. Thank you so much. If it weren't for you, I would have never made this offer. I really appreciate your guidance through this. And what I'm getting at is this. You don't know what you don't know. So if you don't make an offer, it may be a lowball offer. They may say no. They may have to sell it. You look at a property, you may not be able to afford it, right? However, if you're getting rental income from the other 3 units, and they may already be leased out, right? So if the property's $700, $800, and you wanted to pay $450 or $5, well, if you're getting $1,200 from each unit, that's $3,600. If your payment's $6,000 a month, well, there you go. Your difference is $2,400, and now you just bought a property with 4 doors. Now, the reality is most people don't live in a 4-unit property forever, right? So when that becomes your departure residence, you slide one more tenant in there, boom, you got 4 doors that are being occupied, and you're collecting rental income.
I've been in mine for 12 years. You believe that? That's a long time. My friends are like, what are you doing?
That's a long time. That's a long time.
You're 35. It's time to get a house. So that we're working on that.
Yeah.
But yeah, that's a perfect example of what I do in this current market with my buyers. We look at property, maybe their pre-qualification is for $400 per your example, and we're looking at property maybe at $450, because right now, if you look at the average list price as compared to the average sold price in this market, it's 8 to 10% less on average.
Okay.
So properties are selling for 8 to 10% less than the average active listing price right now. So to your point, the market's changed a little bit. If you just make that offer as a buyer, you don't know what's going to happen. And usually in this market, if you make an offer, other people are not making the offer if the property's overpriced, because they're all having that same inner dialogue. It's like, oh, it's $450. I can only afford $400. Yep. I'm just not going to make that offer.
Or I'll keep an eye on it. Let me see where it's at in 2 weeks. If it's still there, maybe they'll lower the price, and then at that point I can make an offer.
But then if that's the strategy you take, you have somebody like the person you coached or the people I coach saying, let's go in and make an offer at $395, $400. And the seller is going to make that first phone call to these guys when they're ready to do it. And they're just going to be like, hey, we got this offer in hand. Why don't we do a deal?
If the home's been on the market for 2 weeks, 3 weeks, 2 months, right? If it's my listing and I'm on the market at $450 and you come in at $375 and I haven't got one offer in 2 months, at that point, all I know in my head is that we now have somebody who has an interest. Now, we're still off. Don't get me wrong. We're $75,000 off. But we want $450. They offer $375. How do we get to a happy medium?
Yeah.
Right? And how long can we continue to keep this property on the market and pay the carrying cost? Right? You never know. I mean, in this particular scenario, they had to sell. There was a passing. It was an older couple. So at that point, they just needed to sell the house and move on. The kids didn't want to deal with it anymore. But to your point, if you got someone that says, "Oh, let's just wait and see where I can't afford $450. I can only afford $4." It's a $50,000 difference. I can't swing that. Well, then you got someone that swoops in that you're working with, and you say, hey, look, let's offer this, right? If it's 8 to 10%, we'll back in the numbers. If it's at $450, 10% is $45. We land at $405.
There you go, right?
So it's exactly what you were saying.
Yeah, it's a thing, and we've won multiple times because of that.
And I'm starting also to see, not to cut you off, I apologize, I'm starting to see a lot more seller concessions. A lot more. So just something to keep in mind.
And I want to talk to you about that too, because there's some strategies you can use to buy down rates and all these other things, right? We'll get into that. So back to commercial lending versus residential lending. Residential lending, you can get 10, 15, 30-year mortgages, right?
Yes.
Okay. And they can be adjustable rates or they can be fixed, right? Yep. That's pretty standard. Typically, if you're doing a 30-year mortgage, that's pretty typical, right? You're doing a 30-year amortization period, right? So that's something to keep in mind too. And a lot of times there's no prepayment penalties.
So there's never a prepayment penalty.
Yep.
On a Fannie Mae, Freddie Mac, if it's a conventional jumbo, VA, FHA, prepayment penalties are really, they're non-existent anymore for the most part. I will say there are few scenarios where the ARM is going to make sense, right? If someone says to you, hey, look, you know what, I'm only going to be in this house at the most 7 years, right? My kids are 15 and 18, right? The older one's going to college. The 15-year-old is in high school for a couple more years, and at that point, my wife and I, we plan on either relocating or downsizing to a condo on the beach, right? The ARM might make more sense. If you know that you're not going to be in that home for more than a specific amount of time, it's always worth it to look into a short-term ARM product.
I agree. Because on the commercial side, as an example, and let's just stepping back to the residential side, you're typically protected by guidelines set by the government, right? In the mortgages you sign, et cetera,
Yep.
right? In the commercial side, all that changes, right? So the commercial side, you don't have these governmental protections.
No, it's a whole different animal.
Yeah, you're signing contract. You have an attorney review the actual loan agreements that you're signing, and all the paperwork that's presented from the local regional bank or whatever commercial lender you're working with. And so on the commercial side, also, there's a lot of 5-year terms, and then it becomes adjustable, or 10-year terms, or whatever that looks like. There's prepayment penalties. There's all these other things, but we'll stay focused on resi lending for now. But that's generally the differences there, right?
Yes. Yep.
Yeah. So let's talk about you kind of mentioned Fannie Freddie. Let's give maybe the newer viewer and newer people the clarity on kind of how this works. You're lending money as a direct lender, right? And then how does where does that loan go? What happens in the background? What's the mechanics?
So really, to simplify it, what I always tell buyers, right, and I always do my initial call with the buyer, right? I have a team, of course, but I like to take the initial call, right, to kind of get an idea of what they're looking to do, right? Where are we buying? Primary home, property type, give me an idea of what payment range we're looking to be in. Are you renting? Do you live with family right now? Really get a better idea of their current scenario. It's so simple, though, right? It's either conventional or government, meaning it's either Fannie Freddie or it's FHA VA, right? Now, if you're a veteran and you want to take advantage of your VA benefits, we will review the file for a VA financing, right? And the cool part about VA is no money down, no mortgage insurance, and if you are a disabled veteran, depending on your certificate of entitlement, you may not have to pay the funding fee. So there's no funding fee as well. So if you're a veteran and you're watching, very important that if you are in the market to purchase, we should be looking into a VA option for you. Absolutely, that would be my first recommendation. And then from there, if you're not a veteran, then it's conventional or it's FHA. And when the loan closes, right, and we always try to get the buyer into a conventional loan product, only because over time, typically depending on the credit score and the down payment, it's going to be a cheaper loan, meaning you don't have PMI for the entire term. It's typically lower PMI depending on the credit score, and rates are going to be, for the most part, very equivalent, right? If you don't qualify for conventional financing, then there's always going to be FHA as a secondary option. Now, the cool part about FHA is we'll go down to a 500 credit score, 580, and you can put 3.5% down. And FHA rates are very competitive for lower credit score borrowers, and the guidelines are a lot more lenient, right? So it allows for collections, charge-offs, repossessions, foreclosure, depending on how long the foreclosure has been seasoned. So there's a few different options if a buyer doesn't qualify for conventional financing. But in terms of how the process works, once the loan closes, right, depending on, it's sold in a secondary market, and then there's a servicer, right? So you may close with CrossCountry Mortgage. We lock your rate direct to Fannie, right? Because we're a direct lender, and then you may get a statement in the mail in 2 months, and it happens all the time, and it's with Select Portfolio or I'm drawing a blank, PennyMac, right? And they're like, hey, Frank, I got this statement. I don't know what it is. Well, the loan was sold in the secondary market. So now you're making your payments to PennyMac or Select Portfolio or whomever is servicing the loan at the time.
So a loan originator will originate the loan, and then once the loan is originated, it can be sold to Fannie Mae, Freddie Mac.
It normally is. I mean, it's very rare that a direct lender, whether it be CrossCountry or Rocket or Supreme Lending, they typically don't service the loan. For the most part, I would say 80% of the time it's sold in the secondary market.
And that makes sense because you guys don't have infinite money. So if you didn't sell the loan, you wouldn't have more money to lend, right?
Correct.
So that's the whole purpose behind being able to sell it to Fannie, Freddie.
Exactly.
And Fannie, Freddie are like quasi-government entities.
So mom and dad of the lending industry.
Exactly.
Sallie Mae is on the student loan side. Fannie, Freddie are on the mortgage side.
And again, their purpose for existing is to basically provide liquidity to the mortgage market, right? Before the existence of them, you would have lenders that would lend to as much money as they had, and then they'd tap out, right?
Correct.
And so that's not ideal if you want liquidity and constant ability for buyers to buy in this market, right?
Correct.
Yeah. So that's basically how it works, and then we're not going to get deeper into it, but then they create those mortgage-backed securities and sell them around the world, et cetera, and that's how they have liquidity to continue to buy.
That's even further behind the scenes.
Exactly. So we'll leave it at that, just super high level for how like the mortgage market works. So let's talk about the different types of lenders. We've kind of touched on it. You mentioned direct lender. We just talked about local and regional banks. There's credit unions.
The big one right now that everyone is, the new the shiny object, we'll call that, is the broker side, right? There's a lot of brokers out there where years ago we were mortgage brokers. Today we're direct lenders, right? So
what's the difference?
So the difference is really a broker is more of just a middleman. A broker is a conduit. So for example, if I were a broker, I could use we'll call them ABC Lending. Actually, there was an ABC Lending years ago. I could use ABC Lending to bring Larry's loan to ABC Lending. So I'm brokering the loan between Larry and ABC Lending.
Does UWM works with brokers,
so UWM
right?
is a big one. They're right now, they're the big name in the game. And great company, by the way. Great company. I've spoken to many different colleagues who have either made the move there or who have been recruited to go there. And they're great. The only thing I feel like
they work through brokers, though, right?
Correct. That is correct.
Okay.
So, for example, if you work for a broker, you have X amount of investors that you can broker to.
UWM being one of the investors.
Correct. So you have UWM, Mutual of Omaha, and there's, I would say maybe, I don't know, there's probably hundreds of them, right? But most companies only have access to, let's say, 10 or 15 of them. So when you have a scenario, Provident Funding is another one you can broker to. So when you have a plain vanilla scenario, let's say it's a 80% loan to value, meaning 20% down payment, great credit score, and buyer has a ton of reserves, you have access to all of these different investors that you can broker to, which is great. In a perfect world, that would be my day, and I could work 2 hours a day and I could do really well. But the reality is it's just not possible, right? Everyone's scenario is different. You're never going to have buyer A, B, and C are going to have the same exact scenario, right? So with that being said, I think where the broker has a little bit of a disadvantage as opposed to a direct lender, two things. Number one, they cannot move as quickly as we can because you're brokering it. So whereas I have the ability to either walk into my operations manager's office or my underwriting coordinator's office and get an answer immediately, as a broker, there's a go-between. So I have to reach out to the broker to ask them a question about their guidelines, which is going to take time. If I want to close a transaction for Larry and his family in 10 days, the broker may not be able to do it.
Because the investor might not be able to do it.
Well, not only just that, it's just going to take more time.
Sure.
Where everything that we do is under one roof.
Exactly.
Right? So if you have a listing in Boca and I have a buyer and you have 5 other offers, and I say to you, Larry, my buyer's offer is going to be, roughly the same as these other offers, but I can close the loan in 7 days, right? And you have 4 other offers, all financing, and they are closing in 25 or 30 or 35 days. The probability is not every time, but the probability is you're going to accept our offer because we're going to get you that seller's money a lot quicker.
And you have a reputation, or CrossCountry has a reputation in this market specifically. This is where I work, so this is what I know. But in this market, they have a reputation. You have a reputation for doing what you say you're going to do.
Yes.
And the reason why you do is because you have control over the whole process. Everything's in-house, right?
Correct.
Whereas you get a pre-approval letter from another random broker. As a listing agent, I get a pre-approval. I get offers from buyers, and they have a pre-approval letter from some random broker. I automatically know that I don't know the answer. I don't know if they can actually execute on what they're saying they can do. I don't know what their turnaround time is going to be. I already know that they're outsourcing stuff, so it's going to be maybe more difficult to close that loan if things get a little bumpy, right? Whereas CrossCountry, I've seen things get bumpy because of the buyer, not because of you guys, or the seller, or whatever the circumstance may be. I've seen things get bumpy, and you and I are on the phone. You're in the processor's office. We're like solving the problem real time. Everybody's talking, literally everybody.
Everyone on my team knows that if there is a transaction that's going sideways, we do not hide behind email. We don't text. You pick up the phone, you dial Larry, whether it's my partner Alex, whether it's Anthony, whether it's Avi, whoever it may be. You get on the phone and we work through it together, because email is not going to solve it, text is not going to solve it, and we've got to get the transaction closed.
That is so refreshing. Like you can imagine, I work with other lenders when I'm the listing agent and buyers bring their own lenders to the process. I mean, you guys really do pick up the phone and solve it real time. Like,
well, here's the reason.
Crazy.
In fairness to them, right? And I'm going to give some of them a pass. In fairness to them, if you're a one-man operation or a one-woman operation, and you've got a buyer on the phone wanting to apply to get pre-approved, you've got a file that's in processing that's going sideways, and you've got prospecting that you need to do to generate more business. It's like being in a band and playing the guitar, the drums, and being the lead singer. You can't do it. So if there's a problem on a file right now, you and I are having a conversation, right? Meaning right this second. But if I have a problem on a file, I have a transaction coordinator that's already on the phone. Where most lenders or most loan officers don't want to take the pay cut, going back to what we originally spoke about, taking the pay cut to bring on the additional staff so then you can scale, right? You can focus your attention on just prospecting, or you focus your attention on just presentations or luncheons or whatever it may be. Because if you're at a luncheon or a presentation and there's a transaction going sideways, who deals with that?
yeah,
You don't want to wait 2 hours until my presentation's done. You want an answer right now, which is why we have a team. It's not possible to do without a team.
I agree.
Meaning scale.
Yeah.
Can you close 3 or 4 units a month? I've had newer guys call me and say, hey, I'm looking to get in the business, and I just wanted to pick your brain. What do you think? And I say, well, it depends where you want to go with it. You want to close 2 or 3 loans? You can do it very easily without any kind of staff. You want to close 20 or 30? It's going to require a lot more than what you think.
See, here's where I see the limitation in saying, okay, I want to be a one-man show and close 3 to 4 loans. I'm cool with that. You're closing 3 to 4 loans. You're not closing 30 or 100 or whatever the number is you guys do. I don't even know. But when you close that many loans, when you close 30, 100, whatever the number is, you develop an expertise, a skill set, relationships with other people in the industry. You develop relationships with the appraisal management companies, all these things, right?
Yep.
That come with, and we could talk about that too, but all these things that come with having some level of scale and exposure and feedback. Because for me, what I see in my business is when I was doing 20 units a year, I had this level of expertise. But then when I was doing what we're doing now, well over 100 units, 100 properties sold per year, I have all this other leverage. I have handymen that are working for me all the time. I have lenders that I have really good relationships with because I'm seeing you like every other day on a phone call. We're dealing with a deal. inspectors, right? Like you just go down the list. I can call all you guys because we do so much business together. We have such a rapport. You're ready to show up and help and bail me out of a situation if need be, because we're all on the same team. Whereas a guy that's doing 4 loans or 4 deals a year, they don't have the same ability to execute that I have or you have.
And so that's why I say it just depends on what you're looking to do. As if you're getting in the business, right? And this is just a recommendation for anyone that wants to get in the business. It really depends on where you want to go with it, right? If you want to keep it very simple and do a couple of transactions here and there, you can very easily do it and make a decent living, right? But if you want to go to another level, like you, for example, going from, like you were saying, 20 transactions a year to well over 120, 130, whatever the number is, right? That requires, you have to scale it. And that's going to require bringing on, building a team and finding the right pieces, right? Because there's only one Larry. There's only so much you can do, right? I mean, you can work 100 hours a week, but to do the numbers that you're doing as a team and be as dominant as you are in the market, you can't do it as one person. I'm sure you would agree with that. I mean, you would lose your mind.
Absolutely. No way. You'd
go crazy.
Yeah. So that's a thing. So that's a little bit about the difference between you guys and others, and the difference between a direct lender and some of these other companies that are lending in the business. So we talked about direct lenders. We talked about some of these brokers as an example. There's also large national banks. We kind of mentioned that earlier, like the Chases of the world and stuff like that. At least that's been my experience. Chase has definitely favored high net worth individuals that have a lot of money or a big relationship with their bank. They will lend pretty competitively on jumbo products, right?
Yep.
What's the difference between a direct lender and a big national branch, as an example? I'll give you my experience too.
So, I mean, here's the thing, right? You never want to talk bad about any company, right? And I had a short stint in retail banking with BOA and Wells. And unfortunately, it's very challenging because it's a big conglomerate, right? Where underwriting, I remember when I was at Bank of America many, many years ago, underwriting we were in Boca Raton, of course. Underwriting was in Texas, and there was a processing center in North Carolina. So I want to imagine that, right? I call you and say, hey, Larry, this is Frank. I'm calling a follow-up. I had sent over a pre-approval letter to you. I understand you're the listing agent on 123 Main Street. And you say to me, well, Frank, I've got a pre-approval letter from you at Bank of America, and I've got one from CrossCountry, and I've got 2 others from direct lenders that are local, right? Explain to me why I should take your pre-approval letter. And I know in the back of my mind, this is going to be a challenge, right? Because I know that if you accept my offer, it's going to be a choppy process. It just is. It's been like that in retail banking for many years. And because they don't have a lot of control. There's a lot of red tape, right? So they can't provide quick turnarounds. They can't provide 24-hour loan commitments. They can't provide a 7 or 10-day closing, because when you've got processing being outsourced, when you've got underwriting being outsourced, you have little to no control, and you don't have any leverage at that point. So I think that's the biggest challenge that the retail banking world has always had, is that most agents, I would say 90% if not more, get a pre-approval letter from a retail bank, and unless it's the only offer on their listing, that typically goes to the side, and they look at the other ones before they even consider that offer.
Yeah, so recently, I mean, just last week, I closed a deal through one of the big banks. I was representing the seller. The buyer had to provide a document to the bank to get their final clear to close, right? And so they did that. A little bit, maybe like 2 weeks, 3 weeks in advance of closing. So plenty of time, right? Somebody responded, said, got it, thank you, right? Within the company. And well, they got it, they thanked them, but they didn't put it through processing, so there was a miss there. And so we found out the day before closing that this needed to be processed, right? It needed to be underwritten. And unfortunately for the loan originator, who was our main point of contact, Like they're trying to get this underwritten and through underwriting, but they are taking forever to do it. And so they don't have that control. Whereas like I've been in situations where last minute documents need to get submitted to you guys within 24 hours. You guys are working all day, right? Yep. It's just like, it's a Sunday, you're working and you're in there, you're getting it done. That becomes a priority. We look, because it was as simple as look at it, stamp it, approve it, clear to close, right? That's how simple it would have been. But we had to extend for 3, 4, 5 days just because of that. And it was a cash transaction, a non-finance contingent transaction. So very easily the seller could have said, you know what? I'll take your deposit instead, right?
Yes.
And so that's pretty crazy. And
they don't have any leverage. That's the reality. Exactly. They just don't. Because what ends up happening is when I remember I was in retail banking again for a very short period of time before I realized it's not for me. When a processor looks at their queue, right? And I'm not going to mention any retail banking names, but when a processor looks at their queue, they're going to look at it and just say, okay, these are the loans that have to be processed. Okay, so if John Smith here is at the bottom, but John Smith has to close in 3 days, but we just got John Smith's documents 2 hours ago, it's not getting moved up in my queue. I have to work on what was submitted, in order from top to bottom. Whereas on a direct lending side, there's a lot more leverage. It's a lot more leverage.
Yeah, right. It's in-house. Now, again, like you said, not talking bad about any of these lenders or banks, et cetera. There's sometimes a reason to use them. As we mentioned, maybe you're a high net worth individual. You have a big relationship with these banks. Maybe they're offering something that makes sense, right? And we're talking a lot on the execution side, and that's like where you and I focus most, right? Because we're trying to make sure your deal gets done properly, and so that's what matters most to us, right? We haven't really talked about rate at all, and rates vary, so it's hard to just say, oh, this guy has a better rate than the other guy, right? So that's I would just leave that out of the discussion for many reasons. But continuing down the list, we have credit unions. I've worked with some credit unions on the commercial side, and they tend to be highly effective for some of the commercial deals I've done if they specialize in that specifically. But there's other credit unions, right, that exist that maybe a buyer would consider if they're getting a residential loan, right?
Yeah, I mean, the credit unions aren't necessarily bad. I think, what draws people to credit unions is they typically they have slightly lower rates.
Right.
Right. The challenge becomes, again, going back to it, do they have the ability to close quick? Do they have the leverage that other direct lenders have, right? And we started seeing this a lot really like towards the end of March, early April 2020, right? It became a heavy, heavy seller's market. So as a listing agent, if you had 20 offers, and in some cases it may have been more than that, right? You, not meaning you personally, but the listing agent would say to themselves, how do I get this property sold and as quickly as possible? That's all I'm thinking about, right? So if you come in, your offer may be competitive with a credit union, right? But if you're coming in with, let's say, a 30-day closing or a 45-day closing, a 20-day loan commitment, in a normal market, 6, 7, 8 years ago, you had a shot to get your offer accepted. But in a market where there's 15 other offers, if not more, the listing agent does not want to see that.
So this is what I've seen. So like, and that's the point. Does execution matter in the deal, right? And sometimes it really matters, like you just said. Sometimes it doesn't matter at all. But if you're a buyer getting ready to go out and shop right now, right? You're like getting ready to go out and shop. You don't know what type of situation you're going to be involved in, right?
No, it's up to the agent to really give them an idea of what the market looks like.
Well, even so, like maybe we stumble upon a deal that execution doesn't matter. Like it's like no one's buying this property for whatever reason.
Yep.
And so like we can dictate, 45-day loan commitment, 60-day close, nothing matters, right? Because this seller specifically is just interested in accepting a deal. Please give me an offer.
Somebody make an offer, please.
Yeah, exactly. So that could be a circumstance. On the other hand, we find a deal that is super competitive. And usually when one of my buyers really likes something, a lot of other people really like it too, right? Yeah. It's pretty common. So in this market, given the fact that there's still low inventory, there's still healthy demand, I would say it matters to be able to execute properly. And also, like, if you're like a low stress type person, you like living in that low stress world, you like little risk, you really probably want to go with somebody that you really believe is going to execute. In the commercial lending space, me and my business partner, whenever we buy multifamily buildings, we have this discussion. Like, who do we believe out of these like 6 commercial banks that we have relationships with, who do we believe can execute on the deal? Who can actually close? Because a lot of times in our transactions, we take a lot of contract risk to win the deal, because usually it's a good deal. It's competitive, as you know. And so we're like, okay, well, we're not going to have a finance contingency, right, on our deal.
That's rolling dice.
Yeah, and that's risky if
Very
we like
risky.
need the money from the lender to close. So we have to have this discussion. Can the bank execute? Can the lender execute? And we have multiple conversations with said local regional bank or whomever we're talking to on the commercial side, and we discuss like, hey, here's what's going on with our contract, and we need to know that you guys can do this. So a lot of times we won't even execute with a new bank in a situation like that, just because we don't know if they can do it or not.
You've never had you don't, not that you don't trust them, you've never been in that position with them.
Yep.
Right. So you don't know the way they execute.
The other piece of this is when we're working together, for example, on some of these multifamily deals that we've helped people get into, house hacking deals, whatever, and other deals that are maybe a little bit more technical. You and I are on the phone with the buyer, having this like group conversation about, here's how I'm going to write the contract. Are you good with this, Frank? Can you hit these targets? You're going back and forth with the details with the buyer. Okay, I have this information already. We're good to go. We can execute on a 7-day loan commitment. We can close in 10 days, whatever the terms may be. You and I are having that conversation with the buyer involved, and we're all talking about this.
The buyer's got to always be involved. And we had one 2 weeks ago where it was contingent on the sale of a house, and they were buying out out west, I remember. And we had it required, in some cases it doesn't, right? But in a scenario where there's a lot of moving parts, there's a sale of a house, and it's contingent, the buyer needs the money from that house to buy the next house, right? That is going to require, and we're going in with such tight time frames, right? 5-day approval, 20-day closing, contingent on the sale. It's mandatory that everybody's on the phone and on the same page, because if not, things get misconstrued very easily. You know what I mean?
Put the mic closer to you. Yeah.
You know what I mean?
Yeah.
So what ends up happening is, if we're not on the same page with the agent and the buyer, the minute that transaction has any kind of bump in the road or any kind of turbulence, they come back to us and say, hey, we were never aware of this, right? So very important that there's always full transparency from all ends.
Yeah, I think one of the deals we recently did, we had me as the listing agent, you representing the seller / buyer, because they were buying a new property somewhere else. So you were doing the loan for the new property. So we had the seller / buyer on a call. You were on a call. I'm on a call, and the agent that's representing the buyer on the call in the new market, just all kind of coordinating the situation, right?
Yeah.
And you don't always get that super easily with some of these other lenders that we're discussing right now. Like, it's just not always happening that way. It's hard.
We just know that in a scenario like that, I mean, don't get me wrong, there are going to be scenarios where it's a plain vanilla transaction where we don't, it requires maybe 5 minutes of a conversation and everyone understands exactly where we're at and knows it, how this is going to, how it should play out, right? But in a scenario where there's multiple transactions tied to one, it's imperative that everybody's on the same page, because if not, it makes for an uncomfortable transaction, and then it'll end up closing ultimately, but the buyer they don't feel the same way they would have had it been a process that was completely seamless, right?
Yeah, no, absolutely. I totally agree. It reduces stress when everyone's in communication.
We don't
too.
like stress.
Yeah.
Not at 41.
I mean, that's the goal anyway. Like, there's a lot going on in a transaction, and I see my job as a broker, especially, and your job too, is to like keep everything together so there's no stress, to give a good experience through the process of selling or buying a home. That's our goal. We're going to execute, but let's keep it also stress-free during that process. And that's something that I value working with you guys for sure. So let's see. Okay, so we talked about credit unions, local regional banks, mortgage brokers, direct lenders, which is across country as an example. And then there's these internet-based lenders, right? So that's another option. What are your comments on just internet-based lenders?
Yeah, I mean, they're out there. They're out there for sure. We haven't had as much competition with them for whatever reason. We saw a lot of them maybe a couple of years ago. There were the Better.com and the Rocket, but we haven't, for the most part, knock on wood, we haven't really had to compete with a lot of them. And the truth of the matter is, the reason is most listing agents aren't willing to accept an offer in today's market with a pre-approval letter from a company that's out of state.
I'll say this. My experience as a listing agent, and as you know, we list a lot of property. I mean, last year, 70, 80 deals were listed out of the 120, 30, whatever we did. And when we see the different pre-approval letters come through, and we've transacted with Better and some of these other internet-based lenders, again, when things get bumpy, it's just hard to communicate. So that's been my experience. Things get bumpy, it's hard to communicate. Now all of a sudden there's stress in the deal.
Well, you have to keep in mind too, not to cut you off, I apologize. You have to keep in mind that at the end of the day, they don't look at it the same way we do, right? I look at it like this. If you refer me a transaction and it goes sideways and I hide behind my email and I don't respond and the communication is not where it needs to be, you're not going to give me another shot, right? It's a very intimate market here in Palm Beach County, Boca Raton especially. Whereas if it's another company, if it's an online company, they're direct to consumer. So they didn't get the referral from you. They got the referral from the company. The company handed them a buyer and said, this person wants to purchase a home. They filled out an application, reach out to them, get them pre-approved. So if the transaction doesn't close, for that particular LO, who works for an online company, it's no sweat off their back because they were never getting a referral from you to begin with, right? If they do a stellar job, you're more than likely still not referring a company based out of Pennsylvania or Wisconsin, right? Whereas if we get a referral from you and we do not perform the way we're supposed to perform, and the buyer comes back to you and says, Larry, that lender you referred to me, I was not very happy with their services, and let me tell you why. Now you've got to reevaluate who you're referring to because it's a reflection on you.
That's a very, very good point. Yeah. So the customer service experience, and that's exactly what it is. In some cases, it's fine. In other cases, it just hasn't worked out. It's been a little frustrating. So let's talk about, for the viewers, let's talk about the different types of loans. We kind of already mentioned some of them. I want to kind of go through them. So you have a conventional loan, right?
Yep. And
it can be conforming or non-conforming. What does that mean? And explain that.
So conforming is any loan amount at or below 726,200. So the minute you exceed that 726, it becomes a jumbo. Guidelines are different. Qualifications are different. Some investors require reserves. So it's really just a conforming loan is any loan amount at or below 726,200.
And it's a loan that Fannie Mae, Freddie Mac will buy, right?
Correct.
On the secondary market,
Correct.
Right? And so 726,200 is the loan amount, the max loan amount that will do
Correct.
that, right? So you can buy a house, say, for $1 million, but the max loan you're going to get is 726,200 if you want to be conforming.
And it's still conforming.
Yeah.
Correct.
Got it. And so then non-conforming, like you said, is a jumbo loan or any other loan that basically isn't conforming with Fannie Mae or Freddie Mac guidelines, so it can't really be resold on the secondary market.
Now, on a jumbo, you can go up to 90% financing. So 10% down payment, you can finance, I believe the max, I'd have to confirm, but you can put 10% down on a jumbo. On a conforming, 3%. On a Fannie Mae, Freddie Mac.
Got it. Okay, so that's a conventional loan. You can go as low as 3% down.
Correct.
Okay. And then the jumbo, you can go as low as 10% down typically?
There is a 5% out there. It's not very attractive.
Yeah.
It's not really something that it's the rates, it's just not attractive. If you can put 10% down, that would be, ideally on a jumbo, 20% is going to make the most sense in terms of rate and cost. But we do have the ability in some cases to go up to 95%.
Okay. So so up to 95%, but really more like 10 or 20% down is usually where I've seen the jumbos, right?
Correct.
Yeah. So we touched on jumbos, and why we would use a jumbo is because it would require us to get a loan more than $726,200.
Correct.
So that would be the purpose. And then conventional is pretty straightforward. Why would you choose a conventional over an FHA, and what is an FHA loan?
So FHA is a government-backed loan. The reason you would choose FHA over conventional really, for the most part, is number one, if you don't qualify for conventional financing. But number two, it really depends on the credit score and the down payment, right? So if you are a buyer who has maybe a lower credit score, maybe collections, maybe some charge-offs, maybe credit that's not necessarily the best, FHA would be an option that we would look into, right? So we had a buyer a couple of weeks ago. She reached out to me, and she said, look, I need to close in 10 days, and I still haven't got my loan commitment from my lender, and I've got an appraisal, and I have no idea if they're going to be able to get this done. So I said, okay, I'd love to take a look at it. Let me see what we can do with it. So we pull credit. We take an application. We pull credit. We gather up docs, and I looked at it with my underwriting coordinator. And I said, I don't understand what this other lender is doing. Nothing about this makes any sense. So I called her up and I said, I don't understand what's the scenario here. Why aren't they able to get this loan done? She said, well, I'm waiting on my loan approval. We're trying to get approved for conventional financing. And I said, ma'am, I have to be totally transparent with you. I said, I don't see any way that this loan is going to work conventional. It's not possible. Your credit score is too low. You've got a late payment on your mortgage in the last 24 months. And I said, your debt ratio is a little too high. I said, however, with that being said, we can close FHA. I said, I do think we can get an FHA approval on this. So she said, okay, great. What's the difference? I said, well, believe it or not, the rate is only an eighth higher. And I said, your PMI is going to be better on the FHA loan than the conventional. She said, okay, great. Can we close it in 10 days? Absolutely. So I remember we had to get the appraisal from the other lender because an appraisal was already done. And he said, I don't understand why is she switching lenders? And I said, look, you're going to have to reach out to him and explain to him that you're not really confident that they can get this done right now. So P.S., she ends up getting him to agree to send us, to transfer the appraisal, and we closed FHA. But the point of the story is that particular lender had the loan structured as a conventional loan with a credit score that was too low for conventional financing. There was a late on a mortgage in the last 24 months. I knew just by looking at it with my underwriting team, there was no shot that conventional financing would work on this.
And see, that's the beauty of working with you guys. I get that transparency right away from you guys. Like, it's like, hey, what works, what doesn't work? Does this work at all?
Oh, we knew right off the bat. There was no shot. And she knew that too. After we had a really in-depth conversation, and she was like, yeah, I'm like, she's like, you're right. I have this late. My credit's a little dinged up. I was wondering why they were trying to go conventional. And I said, there would be no reason whatsoever I said, technically, yes, you do have a qualifying credit score to go conventional because we go down to a 620. She had a 638. I said, so yes, technically you do have a qualifying credit score. But when you run this loan through Desktop Underwriter, there's no way in the world it's going to render an approval on conventional financing. It wants FHA.
Super simple. So
very simple.
There is a place for FHA. There's places, it just makes sense in some cases to go that route for certain buyers. And that's why you need to have this like strategy discussion with your lender.
Think what ended up happening was I think the agent probably thought if I submit the offer as conventional, I've got a better chance of getting my offer accepted than if the listing agent sees an offer for FHA financing. There's this big misconception about FHA financing that it doesn't work, it's bad, there's a specific appraisal. FHA financing has been around for years, and it's a great option for buyers that have maybe nicked up credit, lower down payment, and the reality is they close. The guidelines are actually a lot more lenient than conventional financing.
That's a great point. I talked to sellers and worked with sellers that out the gate they say, listen, I'm not going to accept any FHA loans. Like, I want either conventional with a lot down.
Sellers say that?
I've had sellers say that because they've had some ridiculous experience in the past or they have heard things. And so I have to kind of coach them through, like, sure, if we can get a cash deal, that's great, right?
Of course,
right? Like, sure. Like, yeah, we want that. But, like, to just say that you're not going to take an FHA deal because of your perceived
because a friend of yours down the street had a problem with the buyer that was FHA.
Right. So it's just like, why would you say that? That just doesn't really make a whole lot of sense. And so we have to educate for sure. I haven't had any real issues with any of the FHA deals that we've worked on together and outside of you and I, whatever we've worked on. So I agree. It's a good fit for the right buyer. Absolutely.
There's a huge misconception out there with FHA financing. I don't know why. I don't know who put it out there. I like to find them and really find out what this whole thing with FHA financing is, because FHA makes up a pretty good percentage of the finance transactions in South Florida. And again, going back to it, the guidelines are more lenient than conventional financing. Now, don't get me wrong. If somebody qualifies for conventional, that's the route we typically want them to, we advise them to go, right? Unless the PMI is more on conventional or the rate is lower FHA. But if you qualify for conventional financing and you're a plain vanilla buyer, well, that's great. That's the route we're going to go. But the reality is that only makes up a small percentage of the transactions.
Yeah. Now, let's talk about VA loans. We talked about it a little bit before, but elaborate on why you would use a VA loan, who qualifies for that, what is it?
So VA financing is great. So the only thing with VA financing is we don't have the ability to control the appraisal. That's ordered directly through the VA portal. So that can take up to 21 days. Typically it doesn't. We have them back within 10 to 14 days. So VA financing, I would say we're probably looking at about 15 to 18 days on closing a VA transaction, again, because we don't have any control over the appraisal. But VA financing is great. There's no money down, no PMI, and you may not have to pay the funding fee depending on your eligibility, right? So if you've got a buyer who's got good credit, minimal down payment, and a lot of these VA buyers, they have VA benefits, right? So they use that to qualify. That would be the route I would recommend going.
Sure. And just to be super clear for whoever's watching, a VA loan is a veteran's loan.
Correct.
Right?
Correct.
Yeah. So if you're a veteran, you can qualify for these loans. Yep.
Correct. Yep.
And we've done a bunch of those together, and those are pretty straightforward too. I haven't had any problems. Any concerns from an appraisal perspective besides the timing?
No, not really. I mean, just the timing. I mean, it takes about 10 to 14 days. They can take up to 21 days. I haven't seen them take that long in my career. And then, of course, there is a WDO that is required, which is a termite inspection.
Got it. And so so is that the biggest hurdle there? Like, is that the only thing that's different on a VA appraisal as compared to like a conventional appraisal? They're just looking for the wood destroying organisms.
Correct.
Or the termite inspection report?
Yep.
Okay. And the buyer gets that inspection and provides it to you guys, right?
Correct. Yep.
Okay. And if there is any termite activity, what's the resolution there?
So I guess it just depends on how bad it is.
Yeah.
Right. I mean, it really that's kind of what it is, right? So at that point, it would have to be resolved. There would have to be, I don't know. I think the seller would see the buyer on a VA loan really can't pay for anything.
Understood.
So at that point, it's really up to the seller to remedy that and provide evidence that termite issue has been resolved.
So as an example, they can spot treat for the termites if that's the resolution. They can tent the house if that's the resolution.
Yep.
Replace this piece of wood in the fascia if that's the whatever it is, right? So okay, and the seller can do that, provide proof, and then we're back to doing our thing, right?
Correct. Yep.
Okay, but can they? It's kind of weird because obviously in a VA loan, the buyer's putting down almost no money, right? So can the seller give a credit in that situation, or is that not something that can happen?
So the seller can give a credit, but not for the WDO.
Okay,
so that has to be remedied prior to closing.
Remedied prior to closing.
Yes.
Okay, cool. So that's, and fortunately I haven't experienced that specific situation with a VA loan. Every house we've done has been clear of termites to a degree, right?
Then.
Yeah. Because the reality is down here, and this is for buyers to keep in mind. The common theme here is a house either has termites or will get termites. Yeah, right.
It's so like mold.
Yeah. And then it's just a question of what type of termites you have, and we can go into all that another day. But that's a thing. There's termites in most houses, and so it's dealt with quite often. This is a frequent thing we all experience here.
And what's cool about VA financing as well is VA will allow for higher debt ratios. So the maximum debt ratio on conventional financing is 50%. 49.99 Fannie Mae, 50.4 Freddie Mac. Okay? FHA allows you to go to 56.99. So if you make $10,000 a month gross, your liabilities, including the mortgage, can equal up to $56.99. VA financing, I've seen scenarios where we've run it through desktop underwriter with a 68 back ratio, 74, and it's given us an approval.
Wow.
Now I think it's crazy, right? Because if somebody makes $5,000 a month, I mean, can they realistically afford $2,500 a month in payment with other liabilities? I mean, but they will allow significantly higher debt ratios.
So that's interesting to know about. And again, that goes back to having this strategy discussion early on with your lender. This is something probably worth bringing up right now. How early, and I'll tell you my thoughts on this, but how early should a buyer start thinking about speaking with a lender, like in your opinion?
I mean, I would say immediately.
Right.
And really, because for no other reason than you need to know where you stand, right? Because some people think that, they qualify for a certain price point, and they have this payment in their head. Okay, I want to buy a house for $400,000, but I don't want my payment to be more than $2,500. That's what I'm paying for rent, right? And then when we run the numbers, the payment comes out to $3,500, and they're like, "Whoa, what do you mean $3,500?" Well, let's go over it together, right? Your P&I is this, your taxes, your insurance. This property has an HOA. Oh, and by the way, you're only putting down 5%. So there's mortgage insurance as well. And they're like, whoa. So now here they are thinking they qualify for $400 based on a number they had in their head in terms of a monthly payment. And then when they speak to us or whomever they speak to, they realize that $400,000 is a significantly higher payment than they really wanted to pay. So now they either have to A, scale it back to a lower purchase price or price range, or B, they have to figure out how they can swing this higher payment.
Yeah, that's a huge thing. So like before we even walk out the door to go show property, we highly recommend and encourage our buyers to get a pre-approval letter, an actual pre-approval letter, not this. We'll talk about this later too, pre-qualification or any of the other nonsense that doesn't look at everything, right? Also, my thought, I get this question a lot too, which is like, hey, I'm thinking about buying in a year, maybe 6 months from now. When should I speak with the lender? And I usually tell people, call Frank up now. Let's get him to run everything through the system and answer all the questions now, because there may be something that you guys can plan for or address in your credit report or in your liability section. So by the time 6 months rolls around or a year from now rolls around, you've kind of already been made very clearly aware of what you need to do or what you need to have in place in order to get the house you want.
Correct.
Right?
So it's funny you mention that. Buyer typically falls into 3 buckets. Bucket A is they qualify for exactly what they want, right? So they say, hey, I'm looking to buy for $700,000. Here's my financials. This is what I want to qualify for. Great. Bucket A, they qualify for that. Bucket B is what you and I just spoke about, which is they're in their head, they think $400,000 equates to a payment of $2,500, when in reality it equates to a payment of $3,500. And now they've either got to A, scale back, or B, they've got to be okay with paying a much higher payment than they were anticipating. Or C, they don't qualify right now, and they weren't aware of that. And at that point, it just depends on what their scenario looks like, right? It may just be a matter of credit scores a little too low, but they have the income and they've got the assets, and we've got to work on getting the credit score from 568 to 580 to where they qualify for FHA. Not that big of a deal. But it could be a scenario where credit score is extremely low, debt ratio is, too high, and the reserves are a little light. So at that point, we've got to really put together a solid plan of attack for them, because at that point, they don't qualify.
Exactly. And then there's so many other examples you and I have been through. Business owners, right? Talking to you before they file taxes, right? One in a future year is sometimes helpful, because they may adjust how their income looks, right?
Happens all the time.
Yeah.
We had someone a couple of weeks ago. They for 10 years they filed a certain number, and then they knew they were buying a house, and you could tell. I mean, we didn't coach them on this because, of course, we can't, but their income went up substantially for 2022. Now, the cool part is if you're self-employed more than 5 years and you've got qualifying credit and your down payment is 10 or 20%, when you run it through the system, you only need 1 year of tax returns.
Oh, interesting.
So that those previous 10 years where the income was very light, right, we don't have to factor those in. We only take the 2022. So by taking the most recent year, we just, that's the income we can use. But now if you got to factor in 21 and 22 and average the two, well, if somebody shows 40 grand for 21 and 220 for 22, well, now that 220 is really not 220 because we got to factor in the previous year because you're not self-employed for more than 5 years. And that 220 is 260 divided by 2 is 130, which is a much different price point at that point.
Agreed. So that's a perfect example of like buyers need to understand where they sit and what they need to do. Or if you're getting a raise or taking a job where you have a lot of overtime payments, right? Those things matter too. Like I've been in the situation where we've had to like factor in overtime to get this person qualified, and multiple years of overtime becomes more consistent.
I've had scenarios where a husband and wife are on the application together, and they want to buy. The wife's pregnant, and they want to buy. Let's say after the baby's born, but then the wife was leaving her job. That could be an issue because now we can't use that income. Well, then their argument was, well, I have a W-2 from 2022. Here's my income. Correct, but you're no longer you're not employed anymore. So now we can't use the income. So if that's the case, right? If it's April and you're planning on leaving your job in November or December, right, or taking a different job, or maybe taking a position where the income isn't as much, it would make more sense to get pre-approved today, because if you wait until later on down the road when you're going to be taking either a pay cut or maybe switching positions or going to a different line of work, you may not qualify for the same number.
Yep.
So there's no reason, in my opinion, it can't hurt to apply immediately, because number one, you're going to know exactly where you stand, and number two, if you don't qualify, it gives us enough time to put together a game plan for you.
Agreed.
To put you in a position to qualify.
Agreed. So much. That's and for some reason, as much as I say that to buyers who call me like a year in advance,
doesn't matter.
They don't do it.
Listen, no.
So please, this is a me pleading to you, do it. Just go understand the situation.
Exactly. Yep.
So yeah. The next type of loan to discuss is the ARM, the adjustable rate mortgage. Yep. We've kind of talked about it a little bit before. Let's talk about why you would use an ARM, especially today, and what that looks like and what that means.
So really, an ARM is it's an acronym for adjustable rate mortgage, right? For the newer viewers, and it's a great product if you're not planning on staying in the home for more than a certain amount of time. So, for example, I personally have a 10-year ARM on my house.
Okay.
So I took out a 10-year ARM back in 2020, and our goal is to ideally, my older daughter would be going to college in about 6 years. So my wife and I, our plan is to downsize to something smaller. Ideally, my plan is to go to the beach. I don't know if she's on board with that yet. But either way, we don't see ourselves living in the house more than, I would say, 6 to 8 years, right? So for us, an ARM was perfect. Now, don't get me wrong, a 30-year fix was still a very competitive rate. But when I looked at the two and I said I can get an ARM at this or I can get a 30-year at this, it just made more sense for me to go with the ARM. Now, if I was uncertain on how long I was going to stay there, if maybe we could live in there the remainder of our lives, but we knew that we weren't staying there more than 6 years. 6 to 8 years was the number we had in our head, right? So an ARM is a great product because it gives you the ability to have a lower rate, but again, you have to know that if you don't sell or pay it off prior to the loan adjusting, there is an adjustment there. Now, there's a cap, but there will be an adjustment.
And there's no prepayment penalties on this stuff, right?
Nope.
Okay. And so after the 10 years, it goes to the prevailing rate, or?
So there is a cap. It is, I believe it's 6% of whatever the initial rate is.
Okay.
So if you're at an ARM at, let's say, 3.5% or 4%, it would be 6% above that. But
so
there's
9.5%.
Correct. But now keep in mind, there's caps on the initial, on the first 6 months. So it can only increase max 2% within the first every 6 months, and then it caps out at 6%.
Okay. So it's important when you talk about ARMs to really understand your situation,
Correct.
like what your plans are, and can I afford to carry this if the rate changes and I stay in the house?
An ARM is ideal for someone who buys a home and says, we have a home in wherever, up in the Northeast, and we plan on selling it in 2 years, right? So you have an ARM, you have a 5-year ARM or a 7-year ARM, and you've got a property somewhere else that you know you're going to sell, and then take the proceeds, and then ideally you can pay it off or wait to pay that one off.
Got it. And the amortization on that, and some people might get confused at what I'm about to say here, the amortization on this 10-year ARM is 30 years?
Correct. 30
okay,
year.
Cool. So that basically means, for those who don't really understand this super well, is you're going to pay during your 10 years basically as if you were paying 30 years.
Yes.
Over 30 years. So that's what the payment's going to look like each month based on a 30-year mortgage, but it's really 10 years fixed, and then after that, so is it adjustable for the next 20 years? Is that how that loan works?
Yes.
Okay.
Yep.
It's adjustable for the next 20. Okay.
Yep.
So, for example, for the commercial debt that I take on my multifamily buildings, usually it looks like, I'll just give an example, but 5-year term, so fixed for 5 years, then it's adjustable for the next 5, and then it's a balloon at the end. So at the end of 10 years, right? And usually it's amortized over either 25 years or 30 years. There's a prepayment penalty during the first 3 years of owning the property. So it's usually a 3, 2, 1. So if I pay it off in year 1, it's 3%. Pay it off in year 2, 2%. Pay it off in year 3, 3% or 1%. And so that's typically what commercial debt could look like, really. So that's different from this like residential ARM product, but it's kind of similar.
Yeah.
Right. Yeah. Cool. All right. So what about people ask me about this sometimes, and we don't do as much of it today, and I haven't done much of it recently, but reconstruction loans. Is that like an FHA product, or like where you can basically buy a house and you can get a loan for the work that you're going to do?
Oh, like a 203K.
There you go.
So it's an FHA 203K, and it's really just a renovation loan. So we have a department that specifically handles that. So we don't have, we do them at CrossCountry, but we have a team that actually handles that particular loan. So really all you're doing is you're financing the cost of whatever renovations you're going to do, whether it be kitchen, bathroom. You can do everything but put in a swimming pool.
Oh, interesting.
You can renovate the swimming pool, but it's more or less for really kitchen renovation, bathrooms, flooring, stuff like that. Okay.
And so what are like the qualifications for something like that? You need to appraise for, an appraisal needs to come in that fits this, right? Is that how that works?
So it'll be appraised as if the work has already been completed. And then what'll happen is you have to have contractors, and there's a lot of behind the scenes with that. Those aren't going to close in 10 days. Those are typically a 45 or 60-day closing.
Okay.
Just because there's a lot of moving parts to them.
And that's one of the reasons why they're not super common, at least in my little world right now, just because like we're trying to be competitive usually.
They're very uncommon.
Yeah.
They're very uncommon. You see them more in scenarios where a listing agent doesn't have a lot of activity on a particular listing. Let's say there's a roof issue and you have no buyer for it that's willing to pay cash, and the conventional buyer doesn't want to replace the roof. So an FHA buyer does have the ability to do that.
Yeah.
With the 203K loan.
Okay. All right. So that's a different product altogether. We don't see them a lot. I've done them.
I would say at most we maybe see, I'm going to lie and say 2%, 3%. Very rare.
I've done a couple like many, many years ago before it got so crazy. Again, because you need to be competitive in this market, it's unlikely that, a seller will typically accept something like this that needs a 60-day close and a 45-day.
Where you may see it more is if the property's vacant and there's some things that the buyer wants to do in terms of whether it be a roof or any kind of renovations, then it's more common. But if it's, like you said, to be competitive in this market, to come in with a 45 or 60-day closing on a 203K loan, tough.
It's a little tough. Yeah, it's a little tough. But something to consider. The other like hurdle for this is a lot of people, when they think about doing this renovation loan, they think they're going to either do the work themselves or bring in their handyman buddy, and they're going to go in here and they're going to, I can do a kitchen, no problem. Well, the reality is you can't do that. You need a licensed, insured general contractor or a contractor to do all the work.
And the money actually remains in escrow until, I think they get paid, I want to say it's 50% up front and the balance when the work is complete.
It's similar to a construction loan, like for the house we're building on right now. You're qualified for, 100, a million, whatever the number is to build the house or do the work. And then as you do the work with the GC requests the money.
Yep.
And then the money gets paid out from the escrow.
A lot of moving parts to it.
Yeah. It's not simple.
For a first time home buyer, it's not a bad option, right? But you just have to understand what you're getting yourself into.
Agreed. And then you and I have been involved in some of this too, some hard money products. Could you define for the audience what a hard money loan is and why someone would even consider that?
So really, it's really just a last resort, right? If you don't have qualifying credit and you've got, let's say 30 or 40% down, hard money financing is out there. We don't really do a whole lot of it. I don't have anyone that I typically refer to, but they're out there for sure. Rates are going to be anywhere between 9 and 12%. I don't have anyone that I would say handles our hard money transactions, but I know there's quite a few lenders out there that offer hard money at competitive rates. I mean, unfortunately, it's going to require a lot of money down, but they don't check income, they don't care about credit. They're getting 9, 10, 12%, 2% up front, so that's all they care about.
Yeah, so it's a higher risk product for sure for the lender.
Oh yeah,
for sure. And when's the last one you and I were involved in? I think you were helping. So we were selling a property, and the buyer couldn't qualify for that we were selling a property, and the seller was going to buy down the street, and the seller couldn't buy this property because they couldn't qualify because they still had this house, right? It's already on the market. So they were going to get a hard money loan to buy this deal that they've already were interested in before this other house that they had closed, and then you were going to come in and refinance them after the fact, right? Because the reality is a hard money loan is a short-term bridge loan, really, right? Because you're not going to you don't want to carry
12% for that long.
Yeah, exactly. And most hard money guys are expecting to get paid back in, I don't know, a year or less, or 2 years or less, right? So that's a thing. And then the other experiences I've had with hard money guys is flippers that we work with. These guys, they'll find a property, they'll buy it, they'll put hard money on it because they just don't have the cash to close the deal, and they don't want to maybe do like a full 30-year mortgage. So they'll do this hard money deal with this hard money guy, maybe 12%, 2 points, like you said, and then they'll get in and out of the property pretty quickly. They'll do the work for 6 months, and then they'll call me up to list it, right? And so we'll sell and get them out of that.
So a scenario like that, it's great.
Yeah.
I mean, if you're using it for just a quick, short term, 6 months, maybe a year at most, I mean, it's fantastic.
It's still expensive. I've looked into doing this. Yeah,
it is.
I've looked into doing it on some of the multifamily product we buy, because sometimes we're being forced into a position where we don't want to use our cash, and they want a 3-week close, and these commercial loans, like, they don't close in 3 weeks. So it's just like, that's not happening. So like, you get a 12-unit building and they want $2 million and they want it in 3 weeks. It's like, okay, we can go do the 12%, 2 points on this deal, maybe better because it's a higher loan, but still, I mean, 12% or 2 points on $2 million is a lot of money.
I'm shocked that there hasn't been a hard money company out there that just has a 1-year balloon, 8.5%, 9%, 1% up front, just something where it's hard money, but it's still competitive and it makes sense.
Yeah.
I find that to be amazing. 75 loan to value, 25% down payment, and just something to where, because where are you going to get 10% in the market today?
Yeah. I've seen some different products floating around that maybe have some of those advantages, but there's always a catch, like a qualification catch or a cost that you didn't know about, right? So they exist, but it's rare and far and few between that I'm getting involved with a client that's doing something like that, right? Yeah. So, it's just this, if you can get in the space of the deals we just talked about, FHA, conventional, VA, that's where you really want to live.
I mean, if hard money is your only option, that's at that point it is what it is.
Yep.
Definitely not something you want to have for long term.
Recently, I've sold property for flippers who were stuck in a hard money deal or had a hard money deal, and they were paying these high rates, and they really had to sell in order to get out of the deal, and they were like gonna lose money based on having 12%, right, interest, plus the market's changed a bit. So, they're really kind of in a jam, and some of these guys that are taking this like hard money debt, which that's why it's risky, right? Market changes, and you have this hard money debt, and your only option is to sell the property, and you're going to sell it maybe at a loss. So
you have to know what you're getting yourself into.
Yeah,
it has to be a short-term play.
Yeah, you have to be a pro.
For sure.
So let's talk about just what is included in your monthly payment for new home buyers. What are they thinking about? Principal, interest?
So it's principal and interest, which of course is the amount you're financing, right? So your principal and interest, property taxes, which are a big one, insurance, which is, we touched on that earlier. Insurance is definitely it's on the move for sure, and your HOA and your PMI depending on your down payment, right? A lot of buyers are unaware, not unaware, I shouldn't say that, they don't anticipate the increase in property taxes from one year to the next, right? And the challenge becomes if you go on the county property appraiser site and you plug in the address, you're going to see a number that you don't like, right? Because they tend to overestimate a little bit. So it's very important that the buyer understands, the buyer understands that there is going to be a change in property taxes, right? You do have the ability to port your homestead exemption in some cases, right? If you have a homestead exemption on your current property. So really what you want to understand is, what does this payment look like today? And then what does it have the potential to look like in 1 year from now or 2 years from now?
Yeah, that's a big thing. I think a handful of buyers get caught, and I've had calls with buyers or people who own their home, and they maybe worked with another realtor, and they're like upset with their realtor for not telling them that the taxes are going to reset when they move into this house, especially over the past few years, because prices have gone up so much. So that's something a buyer needs to keep in mind, because the reality is when a lender is underwriting if you qualify or not, they're using the current taxes, right?
Correct.
Which is an advantage to the buyer. That gives them more purchasing power.
Yep.
But they have to remember that you're doing that because that's the only number you have that you can anchor to.
Correct.
Right? So that's what you do. But in reality, that cost is going to change. And in some cases,
you're buying a house for $700,000 today, and the property taxes are $5,000 because the person's owned the house for 15 years. Yes, we're going to use $5,000 to qualify you. However, in 1 year, when the county reassesses that property, that $5,000 realistically could be $8,500. Now, if you're escrowing, you now have an escrow shortage, which in turn does what? Increases your payment. So I've had buyers call me and they say, "Hey Frank, it's so and so. My payment was originally $2,800, and I just got my statement. It's $3,500." And I'm like, "Well, I'm looking at your loan. It's a 30-year fixed rate. I know the rate hasn't changed.
Yeah.
So it's either one of two things. It's either taxes or it's insurance." So they'll send me the statement, and I'll look it up, and I'll check their property tax bill or their insurance, and of course it's gone up. And they weren't prepared because the other agent, right, whether it be mistakenly or just conveniently left that out, didn't mention to them, "Hey, look, there's a chance that this property or that these taxes could increase significantly from 1 year to the next."
Absolutely. Absolutely. And same for insurance. Like lately, as we mentioned earlier, insurance has changed dramatically. Like I know on my portfolio, we've had increases of 35, 40% on our insurance. And we have a pretty large portfolio, relatively speaking. And so, we're getting hit with that. The homeowners that have one house, they're getting nailed pretty good too.
I got hit pretty bad. I mean, I bought my house 3 years ago, $3,900, and I just got my renewal today. Not today. I got my renewal week and a half ago, and I looked at it again today just to confirm. It was about $7,100.
Yeah. Yep.
And there's nothing you can do.
No.
There's really only it's either Citizens, or if you're lucky enough to have the carrier that you've had for when you bought your house, then they're raising their premium as well.
Yeah, that's a whole nother topic, but it's good to, as a buyer, to understand what is happening in the insurance world here in South Florida specifically. And either Frank or I can explain that, and we have great contacts.
Listen, not a bad thing, right? It's not. It's not. We don't say it to. I don't say it to scare you away from buying or scare somebody away from buying, but just something to keep in mind, right? Because we don't. The last thing we want is someone saying, "Hey, I wish you would have mentioned to me that it's possible my taxes or my insurance are going to go up from one year to the next." Because again, I go back to it, and then it becomes a reflection on myself, right? For me not to mention it to a buyer, then they're going to say, "Well, I was going to refer you my sister, but I'm a little upset because, you never mentioned to me that there was a chance this payment could jump from this to this," right? And unfortunately, we don't know what that number is.
Yeah, you don't control it. I don't control it.
We know it's going to jump, but we don't have an idea of what that number is. We just have to prepare you and say, "Hey, look, just be prepared that there's a chance the payment's going to jump."
And the reality is in some cases, my payments on some of the buildings I bought didn't jump, like they were missed or something, like because they should have jumped. And so we look at our portfolio and we're like, okay, taxes increased here, here, and here. But what happened with this building? This building's still flat, right? It's like, why? And then 2 years later, oh, there we go.
Yep.
Like we got it.
Yep.
So you never know. You just don't know what the property appraiser's office is going to see, what they're going to miss, what they're going to do. So we can't control that.
No.
But it's something you need to know that this could happen.
Just setting the expectation.
Yeah, that's exactly. As a buyer, this is hopefully informing you guys on what to be concerned about or focus on and know before going into this stuff, right?
Sure.
Yeah. So and we've talked about this a bit, but what are some things that a buyer should not do while getting or in the mortgage process with a lender?
Nothing.
Yeah.
just sit still. No, really the main thing is using credit. Moving money around is a big one. Moving money around can be a real challenge because we've got to source where that money's coming from, right? So cash deposits, that can be an issue. Moving money from one account to another account without the ability to trail where that money comes from, that's an issue. And using credit, right? Because if you go out and you purchase something a week before closing and you don't let us know about it, and we're going to run a soft credit check before closing, and we see that you bought a brand new BMW and the payment's $1,600 a month, well, now we may have an issue.
Exactly.
Right?
Exactly. That's a great comment. The sourcing of funds is a huge one. It's so frustrating to me sometimes. Yes. So I'm glad you brought that up. I usually, when I'm representing a buyer, have that conversation like, guys, go check your bank accounts and just kind of look through, the money that you've put in there over the past couple months. Did you sell your little boat that you had for $1,000 and deposit it in the account last month? Well, think about how you're doing that. Like, or do you have this like side hustle where you clean houses? I don't know, whatever, right? And you're putting cash in every month. The lender is going to look at that and they're going to ask questions and you're going to need to justify that. So if there are things there, let's talk to a lender in advance. Again, this goes back to the conversation. Let's have a conversation in advance. Understand what you're doing so you can just be super clean and easy. Again, it's going to give you like this like riskless or less risky process, less stressful process.
Less choppy, I would say. It's just it makes for a more seamless transaction. The sourcing of the funds and moving money around is a big one. Just because they think they might be doing something. Well, I got money from, mom gave me a gift. Okay, great. Well, now we've got a source where that money came from.
Yep.
Right. So now we may need mom's bank account. Well, mom doesn't want to give the bank account, the bank statement. Well, unfortunately, this is a requirement, right? So we want to make sure that we know exactly what we have in what account, where the money's coming from, where the escrow deposit's coming from. Are you making it, from a checking account? Are you making it from a savings? Is it coming from a Robinhood account? We need to know exactly what's going on because I always say it's all going to come out in the laundry. Like underwriting will vet this out, and if we're not all on the same page and there's not full transparency, then we can't do what we need to do, right?
You can't guarantee the 10-day close if somebody's like messing around in the background on the buy side, right?
I had one guy tell me one time, he goes, I'll tell you what I'm going to do is I'll tell you the truth and you can make up whatever lie you want. I said, well, I can't do that. I said, but just tell me the truth and let me see what I can do with this.
Yeah, no, it's a thing. Like the buyer needs to be on the same page. They need to understand like the sourcing of funds.
Yes,
and what the consequences are.
Because I've had buyers tell me, and typically it's the the people that are very cash heavy. Well, it's my money. Well, what does it matter? I get it. It's definitely your money. I understand that, but it still needs to be sourced. And if we can't source it, unfortunately, we can't use it, even if it's in your account.
I look at lending as, and this is how I think every buyer should think about this, because I do a lot of I do a lot of financing for all my deals, right? And we, like I said, we have 5-year terms on our stuff, so we refinance frequently. So we're doing a lot of that, and so I'm always working with different banks that need this letter, need this justification, whatever it is, right? And so I look at this as, in order to not get frustrated, I just look at it as, this is a game. I submit documents. They come back and say, we need this. Yes. I give them that. And I don't like get upset. I don't ask any questions. I just understand and accept that whatever you ask for, I have to produce. Yes. And that's it. And so, and the more I can prepare for that moment, which means more I can like avoid having like some random $1,000 in the account that showed up from some stupid thing, yep. I will do. I'll like hold that back, because I know at any moment I'm going to be doing some refinance transaction on one of the deals or a new financing on a new deal we're buying. So it's just like, I look at it as a game. Don't get frustrated, because I have buyers that reach out to me and they're like, oh my God, these banks, they're going to kill me. Like, they want this stupid thing, and then tomorrow they want that, and blah, blah, blah. It's like, well, you just have to understand that that's how you get qualified, period. Yeah. And if we have conversations in advance, sometimes you can avoid a lot of these things.
1,000%.
Right? Yeah.
It's like playing a game. I don't know if you ever go to Boomers. You don't have kids, but I take my kids. Whack-a-mole. Like, something pops up, you hit it, comes up again, boom, you hit it again. It's like every time we get through one hurdle with some transactions, there may be another one, right? But if we would have known about this weeks prior, it may not have, it may have been a more seamless transaction.
Agreed. So, and I make it a point, this is some other coaching for buyers, is I make it a point, you ask for something, like within, I don't know, that day, I'm getting that document back to you, unless there's some circumstance where
Believe me, we don't say this to them, but in my head I'm thinking, believe me when I tell you, the last thing I want to be doing is asking you for this.
Yeah.
Like, I wouldn't be asking you for it if it weren't required.
Yeah, if you didn't have to.
If I didn't need it, I wouldn't ask you for it.
Yeah, absolutely, absolutely. So that's kind of a highlight of just costs associated with what your payment's going to look like going forward, correct. Right? So, and I think it's worth touching on this, or this discussion was worthwhile, because a lot of buyers, one, they don't know what their costs are associated with, interest, taxes, HOA. So it's good for you guys to know that. And then also the change in costs versus from year 1 to year 2, right? So, yep. So let's get into, I get this question a lot. Let's get into just like talking about how to choose a lender, maybe why they should work with you over some other lenders, when it makes sense to work with you versus some other lenders. The first thing I get a question quite a bit about is pulling credit. Is that going to affect my credit score, and how does that look, and how should they think about that?
So pulling credit, right, I always say, number one, pulling credit, you're going to have to pull it regardless. So whether it's me or anyone else, once you pull it, though, you're good for 120 days. So that's the one good thing, right? So if you're above 740, it doesn't matter. Like I've had, I've been on the phone with a husband and wife, and I'll say, well, your credit score is 778, and she's 782, and I can't believe it. I thought mine was 802, and I'm like, sir, if you're above 740, it's
doesn't
the same
matter.
thing.
Yeah.
It doesn't make a difference. You could be 780, you could be 790, 820. If you're above 740, it's a tier 1 credit score, right? So typically a hard pull is going to drop you 6 to 8 points, maybe 10 points. So if you're dropping from 780 to 770, it's not making a big difference, right? Where it can become a little bit of a challenge is if we pull credit on a buyer with a 595 or a 580 credit score, and then they dip below that minimum credit score requirement. But again, I go back to it. It would need to be pulled anyway, right? And this kind of ties into what we were saying about 15 minutes ago, is that if we pull it today, as long as you're not buying next month, if we drop below 580, well, now we have that much more time to get you back in a position where you qualify, right? But if you tell me, Frank, I've got to close in May because my lease is up at the end of May, or at the beginning of May, and I have to be out, within a couple of weeks, and you're calling me today, you're not giving me a whole lot of room to work with, right? So that's the big thing, is that if your credit's not the best, let's pull it early let's not wait until we have a month before you have to close. That way we have enough time to really dive into it and see what we need to do and put together a plan for you.
So what is the difference between like a hard pull and a soft pull? And when is a soft pull happening and when is a hard pull
So a soft
happening?
pull is just we pull that before closing.
Okay.
Right. So it's just one quick check before closing, make sure there's no new inquiries, no debt, nothing like that. No balances have changed enough to where they may not qualify. And then a hard pull is when we initially pull it. We do a hard pull when they want to get pre-qualified.
What if you're a buyer and you come to CrossCountry, you get the hard pull, you get your underwriting, but then you're like, oh, I want to go shop a rate, and the other lender also wants to pull your credit. How do you feel about that? What are your thoughts?
So that's a great question. So if you pull your credit today, right, the credit bureaus now recognize that you're mortgage shopping, and you can pull it as many times as you'd like within a 30-day window.
Okay.
So if you pull it today with myself and you say, you know what, I like Frank, but I want to see if there's a better option out there for me, right, you can pull that credit score as many times as you want within that 30-day window.
And it won't impact your score?
It will not impact your score at all.
Got it.
However, go beyond the 30 days and then you pull it again, it's going to have an impact on the score. Now, if you pull credit with me today and then you go to Home Depot and then you go out buy a car at Honda and then you go to wherever and you apply for a department store card and you pull it 4 or 5 times in a week, then yes, each pull is going to have an impact on the score each time.
Yeah. So again, during this process of buying a home and getting pre-approved and going through the mortgage process, like, don't go do those things.
Yeah, I mean, we have a disclosure that says, don't pull credit, don't apply for new credit, don't, try to keep your balances at a minimum, right?
Yeah.
We want to make sure that you're not doing what we see, right, is a snapshot of your finances in real time today, right? So if we pull credit today and we gather pay stubs and underwriting reviews and we have everything here, as long as everything is, for the most part, status quo through the process, we won't have, there won't be an issue. But when, where we really run into challenges, and we've had this happen before, where a buyer says, hey, there was a great deal at Macy's Furniture and I had to apply that day. It was the 4th of July sale. And I ran credit and I applied for a new card. Okay, well, now we have to factor in that debt against you, right? And if you're really, really lean, if you're at a 55 or 56 on FHA, and now we got to factor in that payment against you, you either A, don't qualify, or B, you may have to pay off something else to get you back down below that 56 number.
Yeah. So, yeah, exactly. So talk to you before you do anything is the big
Always.
thing. Yeah.
Always.
Yeah. So that's the big one. The other thing that I wanted to kind of bring up in this same discussion is you mentioned credit scores, right? So you mentioned a credit score, but what does that look like? How do you think about credit scores? There's 3 different types, right? You consider the middle score.
Yes.
Explain that a little bit.
So there's 3 different types. So you've got your middle score is the score that we use to qualify. All lenders do across the board. And if it's a joint application, then it's the middle score of one applicant, the middle score of the other, and it's the lower of the 2 middle scores.
Okay. Got it.
So if Larry and his spouse apply for a loan and you've got a 780 and she's got a 640 middle, well then we have to use the 640. Ideally, in that scenario, we would look to remove the spouse because we want to use the 780. However, if your spouse makes more than you do and we need her income, well, now we're in a scenario where we have no choice. We've got to use the 640.
Copy that. Okay. So that's probably helpful for some people when they think about this. So some people say, oh, I got an 800 credit score to me right off the cuff, right? It's going to be great. But who knows what score that is. Sometimes they're thinking about this from I just bought a car a year ago and they showed I had an 800 credit score. That could be very different from the score that we're going to use in the lending process, right?
Correct. So
Yeah.
I've never had a scenario where a buyer says to me, I've got a 778 credit score. I just checked Credit Karma today, and we've pulled credit and it's the same exact score. Never. And I've been doing this 20 plus years at this point. Credit is to me the one thing that I feel like it's never been a perfect algorithm, right? That you could pull. I've seen credit reports where the buyer's got a 790 on Equifax and a 630 on Experian, and I don't see any difference in the profile. Doesn't make any sense, right? So, I would say the most important thing is your credit is like credit is so important, right? Because if you can make as much money, you can qualify based on income, you can have plenty of assets. If you don't have a qualifying credit score, hard and fast, you can't qualify.
Yeah.
Right? If you got a 550 credit score and you want to buy $1 million home and you're not going FHA, which you could go FHA theoretically, but if you weren't, right, even if you made $500,000 and you qualified and you had the assets, if you don't have a qualifying credit score, you can't qualify.
So that's one of the primary things that a lender's looking at when they're considering.
Oh, when you really simplify it, it's credit, income, assets. That's it. How's your credit? What does your income look like? What kind of debt ratio? And do we have verifiable assets?
Got it. So to your point, liabilities are considered in that, right? So income
Correct.
versus liabilities. So you mentioned debt to income before, and my understanding is there's a front end and a back end ratio.
Yes.
We were talking about this a little bit. Can you elaborate on what that means and how you think about that?
Sure. So front ratio is very simple. It's your housing payment, right? So it's your principal, interest, taxes, insurance, PMI, and association dues. So if your mortgage payment is $3,500 with everything, and you're on a gross salary of $120,000 a year. So 120 divided by 12, $10,000 a month. Your mortgage payment's $3,500. Your front ratio, your housing ratio, is 35%.
Okay, got it. And what are some of the standards that for a conventional loan, or you mentioned earlier, right?
So believe it or not, FHA will allow 46.99.
Okay.
So what that means is if you are a salaried employee and your gross income is $10,000 a month, hypothetically, you can go up to $4,699 in terms of mortgage payment. Now, I personally think that's crazy, just because it's a high payment.
Sure.
Right, and we're using gross.
Yeah, that's a good for everyone to know. Your gross income.
Gross income.
Right? So that's not actually the income that's in your pocket.
Correct.
Yeah.
Correct. So now what ends up happening is most of the time, buyers will qualify for more than what they're comfortable paying. So that we may, we'll do a consultation. We always do a buyer consultation after underwriting reviews it. In our buyer consultation, we go over price range, down payment requirement, taxes, insurance, interest rate, really all the details so they know exactly what this looks like on paper prior to going out to look for a house, right? And a lot of times, more times than not, we'll say, here's your price range, here's your proposed monthly payment. Now, we have to estimate taxes and insurance, of course. And they'll say, wow, I qualify for $4,500 a month. Yes. I want to be no more than $3,000. So a lot of times they'll qualify for more than what they're really comfortable paying.
Yes, exactly.
Which is good.
Yeah. Yeah, so that's what I tell a lot of our buyers. You're going to get qualified for X, but you need to make a decision on what you're comfortable with purchasing, right?
Yep.
So
now, don't get me wrong. We've had scenarios where it's like, hey, you qualify for $3,500 a month. Well, I want to qualify for $5,000 a month. Well, we can't get you there.
Yeah. Some people push the limit, right?
Oh, they push.
Yeah,
they do.
Totally. I mean, we've done a handful of the deals where we just squeak it out, right?
Yep.
We get it right. We're tweaking the very last things, talking to the insurance broker. How can we get it an extra $200 less? Right? All these different things.
Bare bones insurance policy.
Yeah. We'll work it for you. That's for sure. If that's what you want to do, it's just it's your decision.
Yep.
So that's the front end ratio. Again, front ratio is the cost of the home compared to your gross income, right?
Correct.
Okay,
Yep.
so that makes sense. And then what is the back ratio? How does that?
So back ratio, you take the housing payment, right? We'll go back. We'll use $3,500 as an example, plus all liabilities, credit card payment, minimum payments, credit card minimum payments, student loans, car payments. And then you total that up and you divide that by the gross monthly income. So let's say your other liabilities are $2,000, right? So now you've got 35 and 2 is 55, divided by 10 is a back ratio of 55%. FHA will allow up to 56.99.
Okay. What about conventional?
50.
Okay. All right. So they're in violation on conventional in that case and accepted on FHA. So
now remember, VA may go to 70 in some cases. I've seen 74s, 68s.
Wow.
Yeah.
Wow. So this is all the other stuff that we need to take into consideration in order to approve you for a loan, right? I mean,
Correct.
You can't really tell somebody what they can buy without really understanding their income and their liabilities.
Of course.
Right? So
and what I was going to say was we should touch on is the interest rate buy down program.
Yeah, let's do it.
That's becoming big. So I'll give you an example of how that works. So we have a 3-2-1 and a 2-1 buy down. So the 3-2-1 is going to be 3% less year 1, 2% less year 2, and 1% less year 3. So for example, let's say today's rate is 6.25, right? It's using a fake example. Year 1, you'd be locked in at 3.25. Year 2, 4.25. Year 3, 5.25, and then it caps out and locks in for the remainder of the term at 6.25. So someone would say, well, why would I want to do that, right? So my sister, who unfortunately recently got divorced a couple of months ago, took advantage of that, right? So she said, Frank, I love the program. Let's do it. Because her philosophy was this. Right now, I've got 2 kids in daycare. One goes to public school, elementary school next year. So that's $1,200 that she gets back in her pocket. And then the younger one goes to public school in 2 years, right? So if she has a lower payment year 1 and 2, and even year 3, by year 4, by the time that payment increases, and it jumped from I think year 1 it was about $800 less, then $500, and then like $300, and then it capped out at whatever the payment was. Her mindset her philosophy was, well, at that point, by the time this goes from 3.25 to 6.25, I'll have $2,400 back in my pocket because my 2 kids are going to be in elementary school, right? So I've got that money back in my pocket, not to mention any kind of raise I'm getting the previous 3 years. So I'm okay with the lower payment for the first couple of years, knowing it's going to increase by year 4.
Is there a cost associated with this in any way? Is the
So
rate
there
higher?
is. So here's the caveat.
Yeah.
The buyer cannot pay it.
Okay.
The buyer cannot pay it. The seller has to pay it.
Okay.
So, for example, let's say you've got a buyer and they're looking at houses around $500,000, right? Let's say they find a house they fall in love with. It's been on the market for a month, and it hasn't no activity, hasn't been under contract, just sitting there. So, and as I mentioned earlier, the seller concessions. So, let's say we know that seller has a listing that's been on the market for a while, and they want to sell it, obviously. We can go in, you can negotiate a price with the seller. Let's say that price is $490, $485, whatever it is, right? They verbally agree to it. We write the contract at $500. The seller credits the buyer $10,000 or $15,000, and the buyer simply allocates those funds towards the buy down. Make sense?
Yeah. Yep.
And we're seeing a lot more of that right now. And in fact, a lot of listing agents are actually marketing in their listing,
Sure,
in the details, seller to contribute towards closing cost / buyer interest rate buy down, because they know that's how you entice the buyer to make an offer.
And we're able to do that today more so than we were, and it didn't really make sense a year ago because rates were already so low. But also today we're able to do that because typically homes are appraising for, or will appraise for, more than what they otherwise would sell for.
Correct.
Because the market is trending a little bit downward right
Correct.
now. Right?
So 2 things. Number 1, it wasn't available a year ago.
Yep.
Number 2, rates were still somewhere in the low to mid 4s. So it really wasn't something that was even discussed. And then houses were still moving very quickly a year ago for the most part. Now the market's kind of slowed down slightly. Hasn't slowed down as much as people thought it would. But now you've got a little bit more leverage, right? So if my house is on the market for a month or 2, now I'm starting to panic. I got to sell this house. I want to sell because I'm either A, buying another house, or B, relocating out of state, whatever it may be. So if I'm on the market for 5 and someone comes in and offers me $480, okay, I'll take the $480, but then they come back to me and say, great, let's write the contract at 5. Credit me back $20,000 so I can use that towards the interest rate buy down. Well, for me, it doesn't make a difference. I'm still getting $480. What do I care?
Yep.
I'll sell to you for 5. You take the $20,000. You do the rate buy down, and I'm still getting the $480. Works perfect.
It's a good deal. It's a good way to structure a deal to get one done.
It's a win-win across the board.
Yeah, I agree. what other I don't know, what other types of products do you guys have besides that? Are there any other like creative ways you guys are getting it done?
So there's
today?
also a 2-1, which is same thing, 2% less year one, 1% less year two. So that's another one at that. The only difference with that one, of course, is it's only a 2-1 as opposed to a 3-2-1, and the cost is going to be cheaper to the seller.
Okay.
So just something to keep in mind.
And I mean, generally speaking, you've always been able to do this too, right? You've always been able just to buy down the rate, right?
Correct. You can do that as well. We had a scenario about 6 months ago. My neighbor introduced me to a buyer. He was buying in Wellington, and he made an offer of, I think it was like a little over $1 million. And he ended up, the inspection came back and there were some issues. And he never locked in his rate. He said, look, I'm going to float the rate. He had a 10-day inspection period. He said, look, I'm going to float and see where the market goes. Yeah. So he bet and he lost. The market went the other way quickly. So he said, look, the only way I can make this work is if I'm able to get a rate somewhere in the 4s. So me and the buyer's agent, I spoke to her and I said, look, here's what we can do. If you can get a credit of $15,000 from the seller, now assuming the property appraises, of course, because if it doesn't, this whole deal is it's not going to work anyway. But assuming we get the appraisal and the seller's okay crediting and buyer back $15,000, I can get him back down into the high 4s and he'll proceed. If not, he's still within his inspection period and he can cancel, no questions asked. She went back to the listing agent. Listing agent presented to the seller. Seller said, why wouldn't I do this? They rewrote the contract at $1,015,000 credit, and we got him back under 5%, and it ended up working.
Yeah, so that's something we've exercised a couple times here recently, just getting the seller to give a credit. So
that's a temporary buy. I mean, that's a permanent buy down.
Permanent buy down, which is nice,
correct.
Right?
Yep.
How much can someone buy down? Like, say the rate's like 6, can they buy down to 4? Is there like a limit, or is it like just crazy money?
Yeah, I mean, at that point, getting it down into the 4s. I mean, typically to get it down 0.5%, it's going to cost you 1%.
Okay.
So if it's at 6 and you want 5.5, it's going to cost you 1%.
Okay.
If it's at 6 and you want to get to 5, it'll cost you 2%. Once you start going above that 2% number, it becomes a little costly.
Okay, so it's not linear. It's not
No.
It gets more expensive the more you want to
I had one guy, he goes, rate's at 6.25. Great. If I want to buy it down to 2.25, can I just give you like $75,000? I'm like, unfortunately, it doesn't work like that.
Wow. Okay.
2.25 is not even on the rate sheet anymore.
Yeah. Okay. So there's a limit, and it starts to not make sense, right?
Yes. Yep.
And when you're considering these buy down things, as you just mentioned, there's some personal considerations like how much money I need today versus tomorrow, right?
Yep.
Or how much money I'm going to make today versus tomorrow. Also, if you're considering like a permanent buy down, and say you're going to spend, I don't know, 10 or 20 grand to buy this rate down, I mean, you really need to think about how long you're going to own the property for, right? Because it might not make sense if you're going to own it for a year and you just spend 10, 20 grand, right?
No, it's all a break-even point. At that point, you got to really do your numbers, back into what your break-even point is going to be, and make that decision from there.
Exactly. So that's how we think about it. We think about it as like, okay, I'm going to spend $10K. What's it going to? How many years is going to take me to break even on this? And if I'm going to live there longer than that, well, then it starts to make sense. If I'm not, then
and we do a full buyer consultation with the buyer, and we lay out 3 options, right? So it would be, let's say for example, 6.5 no cost, 5.99, slight cost, and let's say 5.5 if it's even available. And we give them every option, right? We'll even give an option where we'll do a 4th option where it'd be maybe a higher rate and a credit back, right? And at that point, we give the buyer the ability to make that decision, right? We're not going to sit there and say, this is what we're giving you, take it or leave it, right? We lay out 1 or 2, 3 or 4 options, right? Whichever one you think makes the most sense. We'll coach you through it, but at that point, it's really more or less on you to make that decision based on your scenario.
I was going to make that comment. I was going to say you can even take a higher rate than par, right? And get a credit, right? Which is probably, I don't know, how many times have you seen that done recently?
Not a lot.
Not a lot, yeah. Different world, but it exists. It's something that exists.
Yep.
Let's talk about, we mentioned pre-approval. Let's talk about pre-qualification. Let's talk about DU, that type of stuff. What are the differences? What do you typically issue? What should someone try to get from their lender if it's not you, obviously?
So here's the thing, right? Any lender out there can issue a DU approval for the most part. It's really more or less just kind of manipulating the system to spit out a DU approval and just hand it to the agent and say, here you go, right? And I say that because, and I'm not throwing anyone under the bus, right? What ends up happening is not you personally, a listing agent will always say, hey, can you send me the DU approval? No problem at all. And I want to say, do you know how to read it?
Yeah.
Because you don't. If you don't know how to read it, it doesn't really mean a whole lot, right? So if you look at a DU approval, you've got the name, purchase price, down payment, LTV, credit score, and you have all this information here, right? Well, if you look at a DU approval, all they're looking for, meaning the agent, is 2 words, approved, eligible, right? And they think they're good to go. But the reality is, if the person on the other end, meaning me or whomever it may be, right, whichever lender the agent's working with, if they didn't do all of their due diligence up front, that DU approval might mean nothing, right? If you look at a DU approval and you see under the income section, $10,000 a month, who makes $10,000 on the month on the nose, right? Is that the correct income, right? Assets, $50,000. Now, are they? My point is, are they inputting the correct information in there, or are they doing a verbal application? And I'm saying to them on the other line, okay, and your monthly income, $10,000 a month, $10,000 a month, great. And how much do you have in savings? $75,000, great. Boom, you're on DU. I hand you a DU approval.
So many people don't know that what you just said. You just shared.
I would be willing to guarantee 8 of 10 agents cannot read a DU approval.
Yeah.
Have no idea what it is. They look for 2 words and that's it.
And they believe it's hard fact, right?
It's not at all.
And it's not.
It's not.
And so, wow, right? I mean, so that's so what I tell my sellers when they ask, like, what's the deal? And I have a mortgage license, right? I don't know if you know that.
So you could read it.
So I can read it, but again, I don't do it every day. So that's why, like, I have a mortgage license, but Frank is the lender. He's the guy. Like, you don't ask me stuff. Like, I know this stuff, but not the way you know it. And really, we need to talk to you in order to get this all handled. So it's like I don't even get involved in it to a degree. Like, I help with strategy, etc. But again, I can read it to a degree. And the thing is it's like this thing I tell sellers is all based on credibility. It's correct. It's all based on the lender's credibility. So the best I can do for you, Mr. Seller, is I can have a conversation with the lender, and I'm relatively knowledgeable on the topic. So I can ask maybe some tough questions to kind of tease out whether I think this is BS or not. Yep. But that's as far as really we can go. And so that's I can give you my gut opinion on whether I think this person's actually qualified to do this deal or not. And I can give you my gut opinion on the lender's ability to execute if I don't know them. And that's where we're at.
Yep.
Like, that's it. We're taking a leap of faith with said buyer, even if no matter what document they put in front of us, to a degree, right? But you can comment on that.
Here's the thing. As long as a buyer has a qualifying credit score, you can manipulate that system to spit out a DU approval for anyone, right? So if you pull credit and they've got a 780 credit score, 660, 680, whatever it may be, as long as it's above 580 on FHA and above 620, for the most part, you can plug in whatever numbers you want to spit out a DU approval, right? And I've seen scenarios where an agent will say, I don't understand. I had a pre-approval letter and I even had a DU approval. It doesn't mean anything if they haven't underwritten the file prior to sending it to you, right? So if you've got 2 sets of tax returns, if you got 21 and 20, if you got 21 and 22, and 21 is, let's say, 75,000 and 22 is 125,000, and they use the 125 thinking they can use 1 year, but the buyer is only self-employed for 2 years, well, you've got to average those two. So now your 125 is really only 100. So now you've just lost $2,000 a month in income. So if you've got a back ratio of 48 and you're using the most recent year of tax returns, when you've got to be averaging the 2 years, that 48 now might be 54. So it's a whole different scenario. That's what agents, the newer agents, don't understand, is that looking at a DU approval and just seeing approved eligible, it's not enough. It's the credibility reason.
So to define DU, what does DU mean? What is the word?
So DU is simply an acronym for Desktop Underwriter.
Okay.
And it's a universal system every lender uses across the board to, it's basically an automated credit approval. So the same way you would call Capital One, Citibank, Chase, and apply for a credit card, they take your information either online or over the phone, They run it through a system, not DU. I'm sure they have their own system they use, and it spits out an automated decision based on the buyer's profile.
And a DU is relevant when you are getting a conventional conforming loan because it's a Fannie Mae approval,
So
right?
DU, you can run DU for conventional or FHA.
Okay. Got it.
And VA.
Okay. So
VA.
conventional, FHA, VA.
Correct.
You can ask for a DU if you wanted to.
Yep.
But to your point, it's like, it's maybe.
I mean, we send it.
Yeah, totally. Okay, so that's DU. Let's talk about pre-qualification.
Sure.
What is a pre-qualification in your eyes?
So it really depends. I mean, it depends on how a lender defines it, right? Like when I worked in retail banking, they did not ask us or require, and I remember seeing a lot of the employees, a lot of the LOs that worked in retail banking, they would hire within. So what I mean is if you had a person that was either, let's say, a business banker or a teller or whomever it may be, right? They would hire them to be an LO if they wanted to, if they were hiring LOs, right? They would give you the option to move up the ladder within the company, right? So what I would notice is a lot of those newer LOs wouldn't do the pre-approval the way I would do it, right? Meaning they would take the application, it would be verbal, it would be a credit pull, and at that point, based on whatever you told them, they would run it through DU, right, with no documentation whatsoever, and send you a pre-approval letter, right? My whole thing was, if I do that, right, probably 6 or 7 out of 10 times I'm going to be fine. But if the 1 or 2 times or 3 times that I'm not, right, if I send Larry or his team or an agent that does a lot of work in Palm Beach County, right, because again, it's a very small, it's a very intimate industry, right, and I send that and it doesn't work, you're going to call me and say, Frank, you sent me a DU approval, you sent me a pre-approval letter, and you never even did any due diligence on this buyer. You never had it pre-underwritten. It wasn't done the correct way. And I have no leg to stand on at that point. I have to look you in the eye and say, you know what, I screwed up. They were pre-qualified. I took the information verbally because I was on my way to the beach, and I really don't want to do what I needed to do on it. So unfortunately, they don't qualify.
So that's what a pre-qualification is in definition, technically. And pre-qualification kind of has a bad rap in the market to a degree, right? Pre-qual is like, hey, I took everything verbally, and they said all the right things, so they're qualified for X amount of money.
Correct. It was the honor system.
Yeah, exactly.
It's like at school when you went to order lunch when you were in like elementary school, and you would just grab whatever and you go up and pay for it. It was the honor system, right?
Got it. And do you need? Let's just jump back again. Do you need a credit report to produce a DU or no?
You do. Yes.
So okay. So to your point,
correct. So
all you need is a credit
together.
pull to get
Correct.
the DU.
Correct.
But all the other information
Yes.
could be verbal.
So if I'm on the phone with a guy that owns a restaurant, right, and he says, "Hey, I make $300,000 a year," right? I pull credit, 750 credit score. I'm putting 20% down. I plug in all my numbers. Boom, I run DU. I'm going to get an approved eligible, 99 times out of 100. So now I send that to you, but now the restaurant owner sends me his tax returns, and yes, he's got 300,000 gross, but when you back out the expenses, he's showing income of 60,000.
Yeah.
And now Larry's sitting here with a pre-approval letter, a DU approval, and an executed contract for $800,000 that we can't close this loan. So now you're upset. You're pissed off at me, rightfully so. The listing agent is pissed off at you because you referred me, and now they're mad at me, and now I just blew up a transaction where I lost the buyer. I definitely lost the listing agent, and I may have lost the buyer's agent.
Absolutely. Like 100%. Because to your point, when I work with you and I'm working with a buyer, so we're all working together and we're submitting a contract, in this market here locally, when they see CrossCountry and they see Frank and Matt on the pre-approval letter, that pre-approval letter to them is the real deal. You guys have the credibility that
Correct.
they're
That
only
transaction's
issuing this.
closing.
Yeah, they're only issuing this because they know all the answers. Otherwise, they're not giving this document out.
Correct.
And again, so to say all that, what is a pre-approval letter? Like, and how does that?
So, I mean, really, it just depends on someone's definition of it, right? Like, I know there's LOs out there, and they'll give a pre-approval letter and they'll just roll the dice, right? We don't give it until we have our underwriting coordinator review it, and we see final loan recommended. Like, they know, my guys know, look at the notes, because our underwriting coordinator, everything's in capital letters. Okay, so I remember when I first started working with him 7 years ago, I said, Andy, do you type everything in capital letters? He said, yeah. I said, well, why? I said, I can't read all this. I said, can you just type everything that's important in capital letters? And he said, well, everything's important. I said, okay. So I'll show you an email of his. To this day, everything is in capital letters. So what I'm getting at is that until he reviews it and he endorses it and signs off on it, we don't issue a pre-approval letter, right? And that's why we stand behind 7-day closings, 24-hour loan approvals, things like that. Now, if we can't issue a pre-approval letter that day, we'll tell you, Larry, here's the deal. We think it looks okay. We're going to committee it, which is a second-level review, which goes to operations manager, underwriting coordinator, potentially underwriting manager, right, which is a corporate, to make sure it's doable. In the interim, if you'd like to make the offer, you're more than welcome to do that. Copy me on the offer. I'll let the listing agent know we're close, but I can't issue it yet until I get second level to sign off on it.
And a pre-approval letter means that you basically have gathered all the documentation you need.
Yep.
And then it's been reviewed by the gatekeeper.
Yep.
who types in caps.
Yep.
Like my dad. My dad does that too.
All caps.
Yeah. Same thing.
So annoying.
Yeah. I can understand how that's hard to read.
Drives you nuts.
In my defense, John's probably sitting back here, who's recording this right now, saying, "Oh, Larry types in caps a lot too." So, but not all the time. Anyway, so you need to have all the documentation in order to review it and then approve it and then send it out.
Correct.
And so that's why you guys have such a good reputation in this local market specifically for just really doing what you say you're going to do.
Yep.
It's that simple. So a buyer who maybe isn't working with me or you should really try to get a pre-approval letter from their lender. And again, it all depends on how a lender operates, and it all goes back to their credibility in the market.
I don't know. I mean, there's a handful, and don't get me wrong. There's a couple of really good LOs out there, a few with CrossCountry, and there's a few out there, right? But I don't truly know of any other entity that will underwrite a file on the weekend. Meaning, if you called me on Saturday morning and said, "Hey, I'm going to refer you John Smith. He's going to make an offer today. Call him right now. Get an application and let me know if he's good to go." I truly don't know any other entity, right? Our branch will do that on the weekend. We have a 7-day-a-week operation, right? 8 a.m. to 9 p.m. So I think that, again, that's what separates us among many other things, at least in my opinion, that we do in this market is that if you want to make an offer on a Saturday at 10 a.m., we treat that the same way as if you want to make an offer on a Tuesday at 1 p.m. There's no difference.
And I can attest to that. I mean, we've talked on Sundays. We've got pre-approval letters on Sundays. Because the reality is in my world, the brokerage business here never stops. It's always like 9 p.m., 10 p.m. at night. We're getting this contract executed and out, so the inspection period starts at the right time, so all these things happen properly.
You got to be available when people want to look at houses.
Yeah.
And if people work 9 to 5s or, if they work all day and they've got kids and activities, when can they look at houses?
Yeah.
On the weekend.
Yeah.
So, I mean, if you I always tell you, we tell the new hires, if you're not willing to work the weekends, this is definitely not the gig for you.
Agreed.
It won't work.
There's some flexibility in both our businesses,
Yep.
but there's also this element of you're always on to a degree, right?
Yep.
So
Always.
So there's positives and negatives to that. Absolutely.
everything else in life.
Yeah, totally. So let's talk about just fees associated with lending, and I think there's some interesting things we could tease out of this to help new buyers or even generally just buyers who are like shopping around trying to understand what the real cost is for the loan they're taking with these different companies. So what are the main fees that a lender typically charges to give a loan?
So have you looked at a loan estimate recently? How confusing it can be for a first-time buyer?
Exactly.
I mean, it's if you look at a loan estimate, there are numbers everywhere, and there's A, B, C, add D. It's insane.
That's the thing. It's like subtract this, add this. This number's down here, but it's got to be added to the number.
Yeah,
up top.
there's
It's
no
chaos.
way unless you are in the industry or in real estate, that a first-time buyer, for the most part, is going to be able to understand where all these numbers are, where they go, and how they even came up with those numbers, right? So if you really want to simplify it, it's very simple. It's lender fee, title, recording, and state of Florida. That's it. So B is title. So if you're buying a house in Palm Beach County, most of the time, seller pays title. Seller picks, they pay title, right? So that, for the most part, you don't really have to pay attention to. I know it sounds crazy, but...
And if you're looking for a lender specifically, right, you can't compare them on title fees that you guys are estimating,
Correct.
and then another lender's estimating. I've
Correct.
had buyers come to me and say, well, this guy's title fees, this lender's title fees are cheaper than this lender's. It's like, dude, those are all estimates, and the lender does not
Apples
control
and
those.
oranges.
Yeah.
So I always say, if you're looking at a loan estimate, you've got A, B, C. A is lender, B is title, C is recording in state of Florida. Take B and C and don't even look at them, because it's going to be the same no matter where you go. Seller picks and pays title in Palm Beach County. If they're buying in Broward, the buyer picks the title company. We don't know what those fees are going to be. C is recording, doc stamps, intangible, going to be the same regardless. You look at Section A, right? So appraisal, for the most part, is going to run between $575 and $600, unless it's a rush. If it's a rush appraisal, we got to close in 7 days. It could range from $800, could be $1,200. What we do is anything above the first $200, we cover, right? So if the appraisal fee is $575, if the rush is an additional $500, so now your appraisal cost is $1,075. You cover the first $575 because that's what it would have been regardless. You cover the first two, we cover above that. So if the rush fee is $700, you cover two, we cover five. If it's $600, you cover two, we cover four.
I've noticed you guys, and this is why I didn't know this. You guys are always pretty cheap on rushed appraisals.
We are. We got a great relationship with the AMC. We have a fantastic relationship with them. They bend over backwards for us. I mean, we send them quite a few appraisals, and we have multiple branches too. That
goes back to what we were discussing earlier. Because you guys move at scale, you have these types of relationships that benefit the client.
Yes.
Yep.
Yes. And we don't have the ability to pick the appraiser, right? So, excuse me. So we don't have the ability to pick the appraiser, right? All we can do is order through the AMC, which is the appraisal management company, and depending upon how quickly we need that back is going to determine the price, right? It's basically like a bid system, right? So we put it out there, need this back in 3 days, and then we'll get a response from the AMC. You can have it back in 3 days. It's going to cost you $900. And then we'll go back to the buyer and say, hey, look, it was $575, which is what it would be standard. The rush fee is $325. You cover two, we'll cover $125. In that scenario, we'd probably cover more than that. We don't want a transaction to be held up because of an appraisal, right? If it's a few $100s, we'll work with the buyer, right? We want to get that done. So what I always tell the buyer, if you get a loan estimate, take B and C, don't even look at it. Section A, appraisal, lender fee. That's it.
Got it.
Right. Credit report's going to be, $50, $75. I mean, if there's a rapid rescore for something like that. But for the most part, it's $50 for the credit report. And at that point, it becomes, you look at processing, underwriting, origination cost. And that's it.
Got it. And something else to keep in mind, I've seen buyers get held up on this. They may go to one lender, the rate is X, and then they go to another lender, the rate is Y, and they're like, oh, X is lower than lender Y, so let's go with them. And I'm like, hang on a sec, let's just look at the fees real quick.
Yep.
Right? Because there might be discount points in there, so they may be giving you a better rate, but they already applied like a $2,000, $3,000 discount points to your closing costs.
The other thing too to keep in mind is, when was that estimate sent, right? So if you go to lender A on Monday and they're at 6.25 with no points, and then you go to lender B on Tuesday because you want to see if you get a better rate, and the market got better that day, well, now they're at 6 and lender A is at 6.25. Well, are you going back to lender A to see if they're at a lower rate? Because now you're comparing apples and oranges, right? To really do a true estimate, to make sure that you're comparing apples and apples, you get your estimate on your loan estimate whatever day from lender A, right? You get lender A and lender B on a Monday. You go back to lender A and lender B on a Tuesday. You get the same estimate, right? Because if you go one lender on Monday and another lender on a Tuesday or Wednesday, the market may have shifted. It may have gotten better. So now lender A may actually have a better rate than lender B.
Exactly, and I see buyers get frustrated for a lot of reasons in this moment here that we're talking about, right? So, that's a huge point. And then also buyers like to just go to a lender and say, "Hey, what's the rate?"
What's
right?
the
It's
rate?
like, dude, I can't tell you the rate. One, it's changing all the time, and then two, like I don't know if I have all your information. So they really need all of your information in order to really answer that question.
Yep.
It's a little different in the world that I play in on the multifamily and commercial side. They can pretty much, because we have relationships with these banks, I can pretty much go to all 6 of them and be like, what's your rate? What's your terms? What are you doing today? Right. Yep. And it's usually pretty consistent for months at a time, not the rate specifically, but the terms and how they're working in the market. So like I can ask that question, they'll give me an answer. But like when I go do a resi loan, it's different. It's like totally you can't do that.
I've had buyers come to me and say, "Hey, look, I spoke to another lender and they were 0.25% better than you." I'm like, "Okay, well, do you have a loan estimate?" "Yep." Excuse me. And I look at the date. And I'm like, "Well, that was, the estimate we sent you was 5 days ago. The one you have from them is better because the market got better, right? Give us an opportunity. Let me take a look at it and see if I can offer you something better, right? Because the market may have gotten better. Coincidentally, or conversely, the market may have gotten worse." Right? So if you call me and say, "Hey, I'm looking to get a second opinion. I was offered this from another lender," I may come in with a higher rate, and you may say, "Okay, well, I'm not going with that guy. His rate's 0.25% higher than this guy." Well, I give you today's rates, and that guy gave you a rate from 5 days ago, and he still never locked you.
Yeah.
Remember, too, you can't lock a rate without being under contract.
That's what I was just going to say.
So really, at the end of the day, it doesn't mean a whole lot.
You don't know the answer until you lock, and you can't
Correct.
lock without having a signed contract. So you really,
Correct.
Unfortunately, I get some of the frustration from the buyers. It's like, hey, I don't know the answer until I'm already like committed.
Of course, especially a first-time home buyer. You've never done this before.
Totally. So
it could drive you nuts.
So what? Yeah, totally. So what I tell my buyers is, it's going to fluctuate a bit, right? So kind of find the lender that can really execute well, that you feel really comfortable with, and then make sure they're within the realm of reasonability. Yes. And then you need to like really think about, and this is what I tell people a lot too, is like if I'm telling you CrossCountry can execute and they're pretty close, like I highly recommend you just go with CrossCountry because they can execute. So and if there's some random one-off lender that we don't know and you don't even know, and you don't even know if they can execute, it's like, and they're pretty close, it's like, guys, you should probably de-risk in this situation.
Well, two things also to touch on. Number one, we do offer a program that when we close a client, we can refinance them if rates happen to drop, and we don't charge any lender fee or the appraisal. So if we're waiving underwriting, processing, and the appraisal, that's a savings of about $2,100 that we'll wipe out immediately, right off the bat if you're refinancing with us, right? And then I had something else to touch on. Talking about the I'm drawing a blank.
Competing on rate.
Oh, so we do also. What we can do is if we lock you in today, and the market gets better from the day we lock up until closing, we can float you down to a lower rate. So if I lock you today at 6.5, and you've got a 30-day closing, and 2 weeks into the process, the market plummets, and now that 6.5 is 6.25, we can float you down at no cost. So we'll honor the lower rate if it is available.
And I've seen you guys do that before, so yep, that's another advantage. So yeah, so that generally kind of covers just competing rates and cost associated with lending. And when you're a buyer trying to make this decision, it's always good to you could chat with me about this specifically, chat with your broker, and if they're in tune with what's happening, they can kind of help you really think about what to do here.
Really what you got to do is, and it may not be me, right? I hope it is, right?
Yeah.
But you got to find someone that you have a connection with, right? There's got to be trust on the other side, right? So if someone calls me and I lay out everything for them, right? My goal is for us to hang up the phone and for you to say to yourself, you know what, there's no need for me to call anybody else. I trust that company and that gentleman is going to direct me is going to guide me in the right direction. And if I haven't done that, shame on me, number one, and number two, you're free to call somebody else, right?
Sure.
Because you've got to establish trust, because as a first-time buyer, everything that we've just gone over, for them to really have a broad understanding of it is almost impossible.
I agree. I've worked with a handful of first-time home buyers, and sometimes I take for granted how like just dialed in I am on this process. Obviously, I do this every day, and I'm just like, oh man, I can't believe like he's not processing what I just said.
This
to him.
To a first-time buyer would be equivalent to me, like me having to work on my car.
There you go.
I know nothing about a car. I don't know where you put the oil. I don't know where the engine is. I know nothing about it.
Yeah.
I don't even know how to pop the hood, to be honest with you. So for me to have to do any kind of work on my car, that's how I would look at this if I were a first-time buyer. Like, you guys do this every day. You know about it. You have to explain this to me as if I'm, I say this respectfully, a child learning something new.
Yeah.
Right?
Yeah.
And if they're not comfortable with me and you and they don't understand it, then number one, we haven't done our job. And number two, they're going to look for someone else. And I can't blame them at that point.
Agreed. Let's talk about PMI and just kind of go over that, because we've mentioned PMI, mortgage insurance premium as well, MIP, a couple times here. And I just want to make sure people understand what that means and how that isn't really included in the rate, but is part of your cost, right?
So there's PMI and there's MIP. So PMI is private mortgage insurance, and it's required if the buyer puts down less than 20%. And then there's MIP. Now, MIP is a mortgage insurance premium that is charged to a buyer on FHA financing. And then they also have PMI as well. So with FHA financing, you have PMI for the entire term of the loan, the entire 30 years, unless you're putting down 10%. If you're putting 10% down, it's only 11 years. But if you're putting less than 10% down and you're doing FHA financing, you are required to have PMI in the loan for the entire 30 years. In addition to the MIP, which is the premium financed into the loan amount that FHA does require. And there's no way around that.
MIP, is that upfront?
Upfront, correct.
Okay, so
That's
MIP on an FHA loan.
Correct.
Okay.
1.75%.
And then, 1.75 upfront cost based on the loan amount.
Based on the loan amount,
for an FHA loan. But then you're also paying
monthly PMI.
Monthly PMI.
Correct.
Got it. And then, so that's FHA. So to kind of drill this home or drive this home, it's, listen, you got to pay extra to get an FHA loan, right? 1.75% at closing. And then on top of that, maybe your rate, I don't know, call it 6%, your rate's 6%, but then you have this other insurance cost that you're paying on top of that. And that's usually factored in as a percentage as well, right?
Correct.
So I don't know, whatever.
Based on your down payment.
Based on your down payment. Is credit score involved in that or not? Not in FHA. No. Okay. So then, like, what I like to tell people is, like, okay, say your rate is 6%. Well, now don't forget about this other insurance payment.
PMI.
So now you're I don't know if it's 1%, whatever it is. Now you're actually 7%. So
correct.
Right.
So as far as the MIP, that's financed into the loan. So it's no money out of your pocket, meaning the buyer, right? The PMI, that's on there for 30 years, unless you're putting 10% down. Then it's 11. Conventional financing, if you're putting down less than 20%, the PMI is on there. There's no MIP, though. The MIP is only on government financing, only on FHA financing, not VA. So that's why I say it's a lot cheaper on a conventional loan than FHA. The only reason we would go FHA is if a buyer does not qualify for conventional financing. In most cases. Because if I've got a 740 credit score and I'm putting 10% down, there would be no reason to go FHA. Because if I went FHA, I'd have to pay the 1.75 and I'd have to pay the PMI for 11 years. But if I go conventional, there's no MIP, and the PMI with a 10% down payment at 740 it's nominal. It really is. It's not to mention it's probably off the loan in 3 years.
Yep. So these are things you need to keep in mind when really thinking about what your total cost of
Absolutely.
ownership is going to be.
Yes.
When you so you need to factor in these mortgage insurance premiums,
Right.
PMIs, and it changes based on the type of loan you're getting.
Yes.
Simply put. So when you're going to go get a loan, you need to think about this stuff.
Of course.
So
Absolutely.
that's what I wanted to highlight here, because you and I have been throwing around these terms pretty
loosely.
Yeah, and most people maybe didn't catch that. So that's good to know. The other thing I was going to mention, I think it changes when you're thinking about buying or house hacking and buying a multifamily. I think some of the guys that I've worked with, they went the FHA route. They qualified for a conventional, but they went the FHA route maybe for some other reason.
So with FHA, you can put less money down.
There you go.
Right. So the way someone may look at that is, I'm buying an investment property for 3.5% down, even though it's not technically an investment property, because it's structured as a primary home. They look at it like, well, I'm buying a property that I'm living in. Yes, it's my primary, but I'm getting rental income on the other units, so it's an investment property. So even though it's not structured like that, it's a cool way to look at it.
Yeah, exactly. And I think that's what the guys that I've recently worked with were, thinking. That was their philosophy there.
Yeah.
So, now we're talking about total cost of owning this home, and so it probably makes sense to talk about APR versus interest rate and the difference. Could you help elaborate on that?
So APR is going to be the total cost of financing over the entire term, right? So the APR is always going to be slightly higher than the interest rate. The interest rate is what the payment is based on, your P&I, right? Your principal and interest. The APR is going to be, so say for example, you're locked in at 6.5 interest rate. Your APR, depending upon what you're paying in terms of discount points, might be 6.6, 6.7. It's always going to be slightly higher than the interest rate, but you would look at the interest rate. Really, that's really what your payment is going to be tied to.
Yeah, it's your total cost, right?
Total
APR
cost.
You can consider like total cost over a 30-year term or whatever the term of the loan is, right?
Yep.
So yeah, and okay, so I think that kind of highlights or explains that. So you can consider the APR, and sometimes like if you're comparing lenders, it can kind of help, right?
Oh, for sure. Because remember, when you're comparing lenders, right, if my APR is 6.7, right, and their APR is 7, right, that means that the total cost over the entire term is going to be more with them, and that probably means they're charging points up front.
Exactly.
So yeah, they got a lower rate. Maybe their rate is an eighth or 1/4% less than mine. Well, they're also charging $5,000 in discount points, so that's why their APR is going to be higher.
So I think that's a huge takeaway right there. You can use APR to kind of gut check real quick which lender is actually cheaper, right? Overall. Yep. That includes the stuff you're paying up front and the payments over time.
Yep.
Right? Cool. So I don't know. Do you have anything else you want to share just on like the basics of lending? Why a buyer should, or how a buyer should think about choosing a lender? Any other comments?
I mean, really, the main thing is what I would say is you really want to find out early on in the process where you stand. Don't get me wrong. There are people who know that they've got great credit and they've got plenty of money and they're going to wait. And I get that, right? But if you think you're on the cusp of not being able to qualify, you've got maybe a credit score that's a little nicked up, right? And that you need credit repair or some sort. You know that you're going to be getting gift money from family. It makes more sense for me, at least, to really figure out where you stand, because you give the lender more time to lay out what needs to be done, right? I go back to it. If you tell me, hey, look, I got to be in my house by June 1st, and I've got a 555 credit score, and I've got $10,000 in savings, we've got our work cut out for us.
Yeah.
We got an issue here, right? But if you tell me, look, I know my situation's not the best, let's apply today, let's lay it out, put everything, give me the whole format of where I need to be, because I have 7 months, I don't have to be out of my apartment or wherever I'm living for until the end of the year. At least you put not only yourself, but you put the lender in a position to where we're not playing defense. I don't like playing defense.
Agreed.
I got 2 kids, and when I get up in the morning, if they're up if I get up and my kids are already awake, which has never happened, thank God, I'm on defense. So we got to be on offense at all times.
I love that. I love that. Yeah. So speaking of just being on offense, I want to end this part of our conversation with just some examples and how to think about the contract we're submitting if we're a buyer or if we're receiving a contract and we're on the sell side. So some of the important things that I think and that are important to consider when looking at a contract and really requires the lender's input is we'll talk about these things. So obviously, first off, loan commitment period, and or are we waiving the finance contingency at all, right? So I think that's a big one. And you can't really make that decision without like having a conversation with the lender, right? Yep. So loan commitment period basically means we're going to get the appraisal back before that period ends. Yep. We're going to have everything underwritten, and we're really going to know that we're qualified to buy this property, and the property qualifies as well, right?
Yep. Yep.
So you guys have done this in light speed for me 100 times with my buyers, 7 days or less in most cases. Most lenders, for context, historically were doing 30-day loan commitments, right? That was kind of normal. And then this market kind of changed things a little bit recently, and we ended up in that like 7-day window. And there's an advantage to that. It makes the buyer look really strong. So from a seller's perspective, you see a 7-day loan commitment or a waived finance contingency, and I'll talk about that in a second, you can really kind of count on that this buyer is kind of ready to go.
Yep.
Pretty qualified. And that's why you guys are able to do it, because you've done all the work up front.
Correct.
You already know the answer.
Correct.
It's like, 7 days, great, we could do this. We may need a couple more pieces of paperwork, but that's it, right? And then also because of your relationship with the AMC, the appraisal management company, you guys are able to rush appraisals and get those done also within those 7 days, right? Which most lenders, I can't tell you how many lenders I talk to, and they just say, hey, we can't control the AMC. I'm like, well, I know guys that, can get that done. So like, I don't really think that's an excuse, bro,
Yeah.
So that's something to keep in mind. So that's one part of the contract that your broker should be having a conversation with your lender about. So if your broker's never talked to your lender, like, I don't know how you're writing a contract, right?
Yeah, I mean, that's
so
of course.
So just flag for you right there if you're a buyer and you're working with somebody and the lender and the broker aren't talking, right? That doesn't make any sense to me. And then if you do this, call it 7-day loan commitment period, or you really feel that the buyer is very, very qualified to do this, you can waive the contingency altogether, right? And in some cases, that is, a little bit higher risk tolerance required by the buyer because, they're taking the full risk. There's no period where they need to get that loan commitment.
Correct.
Right?
Yes.
So there's a little risk there. But if you're working with a lender that's really got you dialed in and the buyer's really, really qualified, and we really feel that way, and usually it's a conversation with me, you, and the buyer. It's like, hey, real competitive situation. We need to do everything we can. Do you feel good about this loan getting done? And you'll say, yes, he's really qualified. He's great. And we also clearly communicate the risks to the buyer because we can't control everything, but hey, listen, you're basically doing a cash transaction and you're risking your escrow deposit, right? In this case. So keep that in mind, Mr. Buyer. Do you want to do this, Mr. and Mrs. Buyer? And so in that case, you're really making a competitive offer because you're collaborating with you guys who really can execute on the deal. This goes back to knowing your lender can execute, right?
Of course.
So I think that's important. That's another lever you can pull, whether it's you're going to be finance contingent or not, or if you are finance contingent, how many days does it take your lender to get that loan commitment, right? Mm-hmm. And then furthermore, when we do this, say, non-finance contingent deal, we can talk about inspection period, right? So inspection period on these contracts here, customary for 7 days, right? In our market. So if you're making a 7-day inspection period offer, then, we have some wiggle room there because basically the way a contract works here is 7 days, the buyer can exit for no reason at all, right? Yep. So you have that 7-day window to do your inspection, do your due diligence, and we like to use that as the time to also do the work on the loan side, right? So we can waive the finance contingency, but we still have this 7-day inspection period.
You could even waive the appraisal contingency if you wanted.
Yeah, you waive everything. Yeah, if you're waiving finance contingency, you're waiving appraisal.
If you're doing all that work within a 7-day period, right, you can waive appraisal contingency, finance contingency, because if all of that work's getting done in the inspection period, worst case scenario, like you said, you have 7 days where you can pull out no questions asked, and your escrow's not at risk.
And so you need to lock lock arms with the lender. You need to lock arms with the buyer, and we all need to be on the same page. Hey, listen, we're ordering appraisal today. We're ordering inspection today.
In that type of scenario that you're referring to, that would be mandatory for like a conference call, right?
Of course.
It would be me, you, buyer. Here's the deal. Here's how we're going in. We're going to go in ultra aggressive, but we're going to get this house. This is what we're going to do to get you there, right?
Yep.
But we got to be on the same page because there's a lot of moving parts there, right?
So, and we've done this so many times together. Like, I feel a new buyer is going to feel very like, oh my gosh, about this, right? And they should. You and I do this like every day, so it's like, yeah, this is the routine. We got this handled. Call up our inspector. By the way, we do so many deals. We can call up the inspector and say, hey, we need the favor. We need this inspection tomorrow, right? And then you're doing the same thing on the appraisal side. Hey, I need this appraisal back in 5 days.
But imagine being a buyer hearing this.
Yeah.
A first-time buyer, keep in mind. They're like, hold on a second, wait, we're waiving this, we're waiving that. We got to close. Like, they don't even know what's going on.
Closing in 20 days. That's the other thing. It's like, hey, you need this to look like it's a.
But again, going back to what you said earlier, you've got to be aggressive. And a lot of this really started. We saw this really during that whole COVID period, to where we realized that it was going to be a seller's market. So our value proposition to our listing agents was this: we'll get your, if you have an offer and you need to close quickly, we can do it. Right, we staffed up tremendously for that specific scenario. Right, then don't get me wrong. In a buyer's market, we don't have as much leverage. Right, but I still feel like it's still a seller's market in certain areas.
It's absolutely still a seller's market. Yeah, things are softening. It's still a seller's market. There's no question in my eyes that it's still a seller's market. And also think about this: and this is how I operate when I buy my own properties. I give the best terms to the seller. Like, I show up, I'm giving you everything. I'm not even having the discussion about, oh, should I waive the financing contingency or not? No, I'm waiving it. This is it. I do this regularly. I personally do exactly what I just described here, right? And I do this on big commercial buildings. I do inspections in 7 days. People are like, what? Most people do 30-day inspections on commercial deals, right? It's like, no, I'm doing 7. Like, I can get my inspector in here. Like, why do I need more time? I don't. So this is a wrap. Let's just go do this. So I give the 7 days, I waive the finance contingency, and I show up and I get a better price.
Of course. The terms are everything.
So in a buyer's market, the benefit to doing what we just described is, wow, maybe I am willing to give him, $10,000 less, $20,000, $100,000, whatever the deal looks like, right? Because the terms are so good and they're like basically guaranteeing me the close. And some sellers really want that risk-free, peaceful deal to close on the day they want it to close on. And so that's what they value. And so that's the first thing I talk to a listing agent about when I'm representing a buyer is, hey, what does your seller value, right? Simple question. And like, nobody asks that question, right? They're like, what do you mean? What does he value? I'm like, well, does he value price? Overall everything, or does he value terms? Does he have a specific date that he must close on? What do they value? And then when they answer those questions and we talk through them, I'm like, okay, I understand where we need to be now. I understand that, he doesn't value price as much as he values security, safety, and guaranteed closing date because he needs to be out of here by X, whatever the reason is, right? And so then we go talk as a team together and it's like, hey, we need to give the best terms because he's going to accept something if we give amazing terms and guarantee these things. And by the way, you can get this property for less than, maybe what it's worth, frankly, right? Yep. And so I think even in a buyer's market, that is super valuable, period. And I do it. Absolutely. I do it every day. I do it with my deals. So like, and I can speak to it. It's a thing. Yeah. So
absolutely.
So, and to drive that further home, like, I have negotiations with buyer agents all the time, and they're talking about, escrow deposits and like how they don't want to go up to 10% or they want to stay at 5% or 1% is customary for them, and they don't want to put more than 1% in escrow. And from my perspective, I'm like, you're buying the property, right? You're going to spend this money anyway.
Exactly.
Like,
it's your money anyway.
Why are we having this discussion? Yeah. Just be competitive, show up, put the escrow deposit up. And that's what I do. I show up with 10, 20% in escrow for my personal deals.
Tell FHA buyers all the time, if you're going to make an offer, why not just put as much money as you can? If you're putting 300% down and you're buying a house for $300,000, right, and your down payment is $10,500, put the full $10,500. If you're getting a credit from the seller, you're done. That's it.
Yeah.
The money's there. It's in escrow. Let's move on.
Yeah, and you're
Right?
and you look strong.
You look stronger. That's exactly what it is.
And you typically get, a better price, or you win the deal, whatever the situation.
It can't
is.
hurt.
It can't hurt.
Can't hurt.
Yeah,
to look better.
And again, if you have the certain protocols in place and everybody's dialed in, like you're not risking this deposit really.
No.
Right? So because you have the 7-day inspection and you're going to get the appraisal back in time. And so here's something interesting. We did this a couple times. And actually we did it on one of the duplexes that you and I worked on together. So we showed up, we did 7-day inspection period. We offered, I don't know, $710,000 as an example, and 7-day inspection period. And we're working with you, and we did a 20-day close, 7-day loan commitment, whatever it was. And so we got the inspection done day 2. So day 2 inspection's done. Day 3, we found some stuff in the inspection we thought we could negotiate on. It was fine, right? But we negotiated on it. They gave a $5,000 credit. Okay, so day 3, sign the addendum, $1,000 credit. Day 6, appraisal came back light. Okay, great, right? This is great. So like most people will be like, oh my God, the world's ending. I'm like, no, it came back at 7. It appraised at 710, and we knew we kind of had this buyer in a spot. And so I went back to him and said, hey, appraisal came. I know we're not contingent on financing, but we got an appraisal, and it came back at 7. And yeah, I know you're probably going to be upset about this. Like you thought you were doing like kind of a cash transaction to a degree, but you knew we were financing. You let the appraiser in, so we communicate that up front, obviously. And it came back at 7. So we want to drop the price to 700. So he was upset, whatever, but he agreed, and he dropped the price to 700. And by the way, he didn't realize. Again, agents need to be on the ball, and I took advantage of this to a degree. And so, because I'm representing the buyer, that's my job. So he dropped to 700, and then afterwards he was like, "Oh, but the credit,
yeah,
like we didn't.
I was going to ask
that
about
credit's
that.
not included in that."
Yeah.
And I'm like, "Dude, yeah, it is.
Yeah.
You dropped the price. We have an addendum that says $5,000 credit. So he got the credit, dropped the price, and
So he got the credit of 5. They got the house for 7.
Rock and roll, baby.
Love it.
He killed it. Yeah. So
Love it.
like that is an example of, now it doesn't always work that way, right?
The
appraisal comes in light. The guy says, absolutely not.
Yeah.
Okay. All right. So shit. Now what do we do? And we deal with that accordingly. We handle it. We're either moving forward or we're bailing.
Yeah.
And there's a cost associated with that. You paid for the inspection, you paid for the appraisal, but you found out really quickly whether this was going to work or not. And you would have done both of those things anyway.
Of course.
And you still would have ended up in the same place, but you would have ended up there 20 days later, right?
Exactly.
So I think there's huge value in working with you guys for all these reasons that I just kind of elaborated.
That, really and we try really to, because remember, we're representing the buyer, right? But we work with a lot of different agents. So our thing is we try to really put the buyer in a position to where if they really truly want a house, if you tell us, look, this is the house we want, we're pre-approved, we're ready to go, we get on the phone with the agent and it's like, how do we make this work? We got to get this family into this house, because there's emotion behind buying a house, right? Commercial, it's different, right? Commercial is a business, right? When you're buying a 20-unit building, I'm sure for you, it's more of a business decision. Whereas somebody who's got, a family, they want to be in a specific school district, it's more of an emotional attachment to a house.
All right, so let's wrap up our discussion and just kind of talk about what's going on in today's market a little bit, how that has impacted you and your team, and what you guys are doing differently. I know we've kind of talked about this a little bit, but I just want to close out by just talking about the market. And
sure. I mean, in my opinion, the market is it's really strong. It is, and I know a lot of what you see in the media is everywhere you turn. Market's down, prices are down, and you're made to believe that it's not as strong as you think. But from what I see right now, I mean, the market's going to continue. It's going to continue in an upward trend. I do firmly believe that. I think that, like I said earlier, we are one or two sharp pullbacks away from really seeing just a real explosion in terms of buyers hitting the market. This new Hometown Hero, these changes that are going to take effect on July 1st, they're going to be tremendous, right? You're going to see a lot more buyers coming off the fence, wanting to get in the market, buy a home, and I think that sellers too, people that thought they might be landlocked, right? And we touched on it earlier today, that are at historically low rates are going to want to make a move at that point, because that's going to be their opportunity to sell. They're still going to get at or close to whatever they ask for in most markets, right? And I think that we're going to see a huge influx of buyers hitting the market in the next couple of years, or the next couple of months, I should say. I
do agree. I think the market is generally healthy. And while there has been, an increase in days on market and an increase in inventory to a degree, we're still at relatively low inventory numbers, right?
Very low.
So this market, I suspect, is gonna stabilize and be very healthy.
It's a normal market, right? I mean, people are like, it's more of what it's supposed to be, right?
Yeah.
The market during COVID, I mean, it was, when you have rates that low, when you've got buyers coming from out of state, whether it be the Northeast or California, there was a lot going on, right? To expect the market to continue with that sort of trend into the infinite future it's not realistic, right? This is more of what a normal market and a healthy market is going to look like.
So yeah, I think everything is fine here. I think I'm not worried about the future of the market, and I don't think anyone else should be. We've seen situations where, obviously, if you don't have the most desirable house because you haven't upkept it and you need a brand new roof and all these other things, it takes a little longer to sell today than it did a year ago. But that is normal, right? That's a normal expectation, right? So I think, generally speaking, we're in a good place, and I think everybody should realize that. And I don't think any buyer should be afraid to jump into the market because of, the market's going to crash or anything like that. I would just say, let's go get it. If the right time is for you to buy now, if the right time for you is now, do it now. That's what I tell everybody, whether it be sell or buy. That's how it works here in the residential world, right?
Of course.
So Frank, thanks for taking the time, man.
Thank you, brother.
Pleasure.
Appreciate it, man.
Yeah.
Thank you so much. I really do. Appreciate it.
And if you want to reach out to Frank, we're going to put his contact information in the description and all that good stuff.